Good morning, everybody. I have to repeat some of what she said so that we can put it on the record, so we go on the record. We're now on the record in the Office of Tax Appeals oral hearing for the appeal of Eran Drori. Case ID is 1805-3245. We are in Van Nuys, California. The date is Tuesday, October 29th, and it's approximately 10 a.m. My name is Jeff Angija, and I'll be the lead administrative law judge for this hearing. My fellow co-panelists today are Andrew Quee and Suzanne Brown. And appellants, can I get you to identify yourselves for the record?
Gary Slavic, counsel for appellant Eran Drori.
Eran Drori. Robert Molina.
All right. Thank you. And for CBTFM?
Chad Backus.
Steve Smith.
That should be on. If not, we may have to share.
And Lisa Renata.
And this is a good opportunity for me to remind everybody, please speak directly into these microphones and slowly enough so that we can have everything heard by the court reporter. So this appeal involves two issues, which are whether the notice of determination issued to appellant was barred by the statute of limitations, and whether appellant is personally responsible under Revenue and Taxation Code Section 6829 for PD financials, unpaid liabilities for the period of April 1, 2009 through June 30th, 2009, basically the second quarter. I realize the NOD was for a broader period of time, but an amended return has eliminated that, so we were talking about 1 quarter. And is that correct, or am I missing anything for the issues?
That's correct, Your Honor.
And then during the pre-hearing conference, the parties agreed to the admission into evidence of appellants exhibits 1 through 3. This that was provided, I think it's already in the record.
I thought it was. I do not believe it is in the record. That is simply the third quarter sales tax return. That I don't believe is in the record.
Is it part of your exhibits, CBT?
I'm not entirely sure. It might be part of the dual packet. I can check.
Well, let's mark it Exhibit 4. And if there's no objections, we'll admit appellants exhibits 1 through 4.
No objections.
And CDTFA had exhibits A through L with the revised exhibit list that was added. I don't believe there's any objection to the admission of those exhibits.
No objection.
All right, then I hereby admit those exhibits, CDTFA's A through L. And based on the pre-hearing conference, it's my understanding that both Mr. Drori and Molina will testify as witnesses today. All right, I'll swear them in a minute. And then during the pre-hearing conference, it was agreed that we would begin with appellant's testimony and argument, not to exceed 40 minutes. CDTFA, as well as the judges, can ask questions if they wish. And then CDTFA will make its presentation, not to exceed 30 minutes. The co-panelists can ask questions, and then appellant has a 10-minute rebuttal. Does anybody have any questions on the process before we start?
No, Your Honor.
All right. Okay, then I can swear you both in. If you both please stand and raise your right hand. And then I'll turn it over to you to begin your presentation. Do you solemnly swear or affirm to tell the truth, the whole truth, and nothing but the truth?
I do.
All right, thank you. Mr. Slavic, go ahead and begin when you're ready.
Thank you, Your Honor. As you're aware, the issue in the case is whether Mr. Drori is personally responsible for this sales tax liability of PD Financial Corp. For the second quarter 2009. PD Financial, also known as Peach Direct, sold electronic goods to consumers that made purchase on credit. The corporation was large, had over $200 million in revenue. It had dozens and dozens of employees, multiple departments, different job functions. Mr. Drori was the CEO, Mr. Molina was the president and secretary, and Dan Grant was the CFO. The payables were managed by the CFO, Daniel Grant, and his finance staff of 7 individuals. Sales tax matters were also handled by CFO Daniel Grant and his staff. In fact, all communication with the CDTFA was clearly with CFO Daniel Grant and his staff, as reflected in the exhibits and the ACMS call logs with the department. The corporation ceased operation in October 2009 due to issues with the finance company. It was after the company ceased operations that CFO Daniel Grant advised Mr. Molina and Mr. Drori that there were substantial amount of unpaid tax liabilities, including sales tax liabilities. The first issue is a procedural issue, Your Honors. It's whether the CDTFA issued the notice of determination under 6829F in a timely manner. They initially they did issue the notice to Mr. Molina in April of 2013. They claim to have also issued one to Mr. Molina. However, they mailed it to the incorrect address, and the board has subsequently dropped that appeal based on the fact that there was an error in the improper mailing of their notice. So here, under 6829F, the CDTF has 3 years from the last date of the calendar month following the quarterly period in which the board obtains actual knowledge of termination, disillusionment, or abandonment of the corporation. That's a mouthful, but what that means is here there's no dispute that the business activities terminated on October 30th, 2009. The dispute is whether the board had knowledge of the termination in the last quarter, the fourth quarter of 2009. If they had actual knowledge in the last quarter of 2009, the last day to issue the notice would be January 31st of 2010. And if that is true, which we believe is true, the notice is late. The board contends that they have actual knowledge early January, mid-January, which luckily for them, under their theory, gives them another quarter and gives them until April 30th, 2010 to issue the notice. And lo and behold, they issued the notice on April 26, 2010, approximately 4 days before they claimed the statute ran. However, it was over 3.5 months, or maybe 2.5 months after we believe the statute ran. And lo and behold, in their rush, they mailed it to the wrong address, and lucky for Mr. Molina, he's no longer on the hook for this, potentially on the hook for this. I want to bring your attention to an exhibit, Exhibit 1. Exhibit 1 is a memo from Board Specialist Rita Lopez responding to Henry Chen's questions at Tax Council and Appeals. Under paragraph number 3, question number 3, the second paragraph under 3, she states, additional research was conducted on PD Financial Corp's ERSTF 093-080656 account. ACMS notes show that on 12/16/2009, Daniel Grant informed Special Taxes and Fees Representative A. Sable that Peachtree Direct ceased operations on October 31, 2009. So there's the knowledge. The board will try to, I believe, try to distinguish that. And there were some statements that maybe Daniel Grant did something different. Maybe he said there was some other activity other than Peach Direct. But PD Financial had no other activities other than this Peach Direct. Peachtree Direct was their trade name as well as venue. It was all one activity. And so clearly, right there in the board's, in a memorandum from the board, under her research, she identifies 12/16/2009 as the date the board had knowledge. Therefore, the notice is late. We can look to Exhibit 2. Exhibit 2 has a second Exhibit 2 because Exhibit 2 is a memo from Rita Lopez, but she attached her own Exhibit 2 to that. So maybe a little confusing, but when you look to Exhibit 2 of Exhibit 2, the fourth page in, this is also ACMS notes, dated 11/13/2009. Now this is about a month prior to the December 16, 2009. ACM notes show Board Representative A. Sable called VP of Finance Shiva Baharani on 11/13/2009. The notes read, called and spoke to Shiva regarding possible payment on their account. She told me that Peachtree Direct is closing business operations in a week and have laid off all their employees. Consistent with the 12/16/09 call to Dan Grant. Also in that exhibit, on November 18, 2009, also a month before the 12/16/09, A. Sable spoke to Shiva Bharani again. Notes read, spoke to Shiva to get updates and additional information for Peachtree. Shiva gave same info that business is closing down and currently they're receiving calls from other creditors demanding payments. I asked her if PD Financial Corp have any other business ventures aside from Peach Direct, and she said there's no other business operations for PD Financial Corp. Clear indication of knowledge. On November 24, 2009, the notes say, received levy response from Bank of America Merchant Services with merchant processing account already closed. The merchant processing account was closed. More indication, this is just adding up to the indication that the board had actual knowledge of the ceased operation. On 12/7/2009, in the notes, A. Sable tried to call Shiva Baharami to get an update on the account, but now the phone's disconnected. Okay, consistent with then her trying to reach out to an officer or somebody else. That's when she reached out to Daniel Grant on 12/16. I believe she sent a letter to him at his home. Why? Because the business was no longer operating anymore. She couldn't contact anybody. She sends a letter to Daniel Grant at his home. This is all in the record. And he calls her, Shiva, I'm not sorry, he calls Sable, say, what's this about? And that is in that conversation, he says the business is no longer operating. And so based on these contacts, it's clear the board had actual knowledge that the business terminated operations on or before December 16, 2009. Therefore, the notice is issued outside the statute of limitations. On the second issue, and we will get testimony from the individuals on this, I think the testimony is not overly necessary for the first issue because it's all in the board's records of the ACMS notes. Okay, so the second issue is whether Mr. Drori is personally responsible under 6829. As you know, there's 4 elements for him to be responsible. As I think Your Honor mentioned, the first 2 are not in dispute in that the corporation business has been terminated. Everybody agrees it was terminated on October 30th, 2009. Again, the dispute is when, going back to the first issue, when they received the actual notice of that. But there is no dispute, October 30th, 2009 was the business terminated. The second element also is not in dispute. That's just a technical rule that the corporation collected sales tax reimbursements on its sales of tangible personal property and failed to remit the tax. So what's the remaining 2 issues, right? It's that Mr. Drori did not have control or supervision of and was not charged with responsibility for filing the returns or payment of tax, nor did he otherwise have a duty to act on for the corporation complying with sales and use tax. And there'll be testimony to this as well, that Mr. Drori was not responsible for the sales tax. Rather, Dan Grant, the CFO of this large corporation, was responsible, and his staff. Further, Mr. Drori did not sign any tax returns. He didn't review or prepare any of the tax returns. You'll see in the record, the second quarter is signed by William Chow, who was the controller at the time, who worked under the CFO Daniel Grant. The third quarter, which we just added to the exhibits, also shows that an individual, Ty Reber, took over, was also working under Dan Grant, and took over some functions, and he signed the third quarter. And why is Ty Reber relevant? Ty Reber, there's a declaration, exhibit number 3, which is in the record. I won't go over too much because your honors can read that, but it explains the duties of Daniel Grant and his staff, and the lack of responsibility for Mr. Drori and Mr. Molina. The board tries to discount Ty Reber mainly because his title in this declaration, the board believes that he would not have specific knowledge of this. However, it's clear Ty Reber does have knowledge. In fact, he signed the third quarter return set forth in Exhibit 4, the sales tax return. So he clearly has hands-on experience. He signed the return. So any claim by the board that Ty would know, Ty made a statement that in the declaration that the only time the checks went to Molina or Drori is when there was 2 signatures needed on those checks. The board tries to discount that because there was some testimony that in 2008, 2 signatures were no longer needed anymore, so how is that relevant? I think it's unclear if that's true, but I don't think there's any relevance to that argument by the board. So his declaration speaks for itself. It's under penalty of perjury. The board does their questionnaires of different people during their investigation, and I find it interesting when we look at Form BOE 1509. They're under Exhibit B. There's many of them, maybe dozens of them even in. And question number 5 is the one asking who's responsible, and everybody's pointing to different. There's consistency. Some point to Melina, some point to Drori, some point to Shiva Barani, who was a finance person, some point to Daniel Grant. But the interesting thing, the question in question number 5, and I think it's very important to read this question. It says, provide the name, address, and telephone number of any officer, manager, member, or person who had control, supervision, responsibility, or duty to act for the business in sales and use tax matters when the business was terminated. Was terminated. Was terminated. When it was terminated, no employees were there anymore, and sure, everybody's going to say Mr. Drori and Mr. Melina. They're the ones left standing. And so, and I think I picked that up when one of the answers said at termination, I don't know. Okay, and so I think this question is written. I don't know what the intent of the question is, but at termination, I don't think there's a dispute. At termination of the business, there's 2 people left standing there. Okay, so the reliability of these statements, which is everything the government is basing their case on, is flawed, severely flawed. And for the second, the 4th element of the 6829 is willfulness. Now, we all know this isn't a willfulness, criminal willfulness standard, unfortunately. It's more like a negligence standard, in my opinion, it looks like. But in any event, just because Mr. Drori is an officer clearly does not make him a responsible person. I think it's in the manual, it's in the law, and I think that the government's relying on the fact that he's an officer, therefore is responsible. The testimony will show, and the record shows, that Mr. Drori did not learn about the unpaid taxes until after the business ceased operations. When did it cease operations? October 30th, approximately 2009. Sometime after that, Mr. Drori learned about this, and at that point it was too late to do anything about it. And you'll see, testimony or statements that Mr. Grant, when asked about who to pay, William Chow, who was the controller, made a statement somewhere in here that he went to Daniel Grant and said, who do we pay? We're low in money, I believe. And he claims that Daniel Grant said, I need to go talk to Mr. Drori and Mr. Melina. Mr. Grant then came back and told Mr. Chow that they were going to pay payroll taxes, and sales taxes. And Mr. Chow seems to indicate that he believes that Daniel Grant got those instructions for Mr. Drori and Mr. Melina. And we do not believe that to be an accurate reflection of what happened. That at no time did Mr. Grant go to Mr. Melina or Drori and ask those questions. In fact, there were some issues with Mr. Grant. There were some embezzlement issues. He had taken some money from the company. There was a note repayment that he fessed up to it and was attempting to pay it back. So we're not sure about his credibility. He's pointing the fingers at these 2 guys. Why? Because the board was looking at him. Okay, the board, he was a potential responsible person. In fact, he is the responsible person. He is the CFO. This is a large company. He had a staff of 7, and he should have paid these sales taxes, or he should have brought to the attention of somebody if he believed they couldn't be paid. And at this time, I think I'd like to call a witness. Sure. Okay. Call Mr. Bob Molina first.
And you're already under oath, just please speak to him. You're already under oath, just please speak to him.
Okay.
Mr. Molina, tell me what was your role with PB Financial?
Technically, I was the president of the company and the secretary of the company. Most of my responsibilities dealt with business development and relationship between the company and its lenders and investors and vendors.
Tell us a little bit about the company.
The company was we were a significant operator in the business of offering a wide range of merchandise, principally electronics, consumer electronics, with a very strong bias towards providing financing for individuals who might have difficulty otherwise being able to afford these kinds of consumer goods. We functioned over the years, probably the company did $200 or $300 million in revenue. We were financed by a number of major institutions, by HSBC, by GE Money Bank, ultimately during the period of time that's relevant here, by ADS, actually a subsidiary of ADS, World Financial Bank. And we functioned principally over the internet. We would take orders both by telephone and online, and that was essentially the business that we were in.
And what was the structure of the departments?
We had a very substantial overhead and a very substantial number of personnel. Again, the relevant issue here has to do with our finance operation, and our finance operation was headed by CFO Dan Grant. He had a staff of either 6 or 7 below him. We had a financial vice president, we had a controller, we had a number of clerks and others that were performing those services. And we relied upon Dan. The fact that we relied upon Dan ultimately turned out to be a substantial error, because the fact was that over a period of time without our knowledge, he in fact managed to appropriate for himself close to $800,000 of the company's funds. But the reality was that happened in large part because Dan ran a completely independent operation. We relied upon him, we relied upon his staff. We didn't get involved in the normal course with any of the kind of daily and monthly and quarterly routines, including issues with regard to sales tax. We were a company that we took these obligations seriously. The company was audited during that period of time by Price Waterhouse. Dan had come out of a large accounting firm, and we were confident that he was doing what needed to be done to protect us.
And did you have any, did you or Mr. Drori have any responsibility with respect to sales taxes?
It depends on what you mean by responsibility. I mean, if you're asking whether we were involved in that process, the answer is absolutely not. We looked to Dan and his staff to deal with that. We didn't sign the returns, didn't review the returns. That was all done by Dan and his staff.
At some point, did you and Mr. Drori become aware that there was a sales tax issue?
The answer is yes. We became aware of that subsequent to the point at which the company had basically ceased operations. And I think it's relevant, if you think of it in terms of the posture that we had, that it turns out we're talking about the second quarter of 2009, but the third quarter was paid. The reality is we had no reason to believe that there was any kind of a prior omission in terms of sales tax obligations. We learned about it at a point in time where the company no longer had the funds to deal with it.
Okay. So there's a statement from William Chow, I think I talked about it a little bit earlier, that sometime before the filing of the second quarter return, which was signed on July 29, 2009, the controller, this is a statement that the controller said that Controller Mr. Chow asked CFO Grant how much to pay before filing the second quarter 2009 sales tax return. The CFO Grant, according to Chow, responded that he needed to first discuss it with you and Mr. Drori, and that he then came back and told the controller that the priority in payments would be first to payroll, second to payroll taxes, and third to sales taxes. Do you recall, here's the question, do you recall Mr. Grant coming to you at that time and asking you to pay, what to pay, how to pay, or priority of payments?
I do not.
You don't recall, or you don't believe that happened?
I do not believe it. I do not recall, and I don't believe that it happened. It would have been entirely out of character for them to be dealing with us in those kinds of issues.
And tell me a little bit about Ty Reber.
Ty was a very long-standing employee of the company. He rose from being, I think, originally hired, I'm not sure what the title was, I believe it as a clerk in the accounting group. He ultimately ended up becoming the controller of the company. He certainly had access to and kind of an insight on all of the operations of the accounting group. And when this issue arose, because it was inconsistent with our understanding and our record of how the company had operated, we went to Ty to ask for that declaration.
And who is Shiva Baharami?
Shiva was the vice president of finance. She worked for Dan Grant.
And who was William Chow?
He was, during this period of time, prior to Ty becoming the controller, he was the controller who worked for Shiva, and Shiva in turn worked for Dan.
Do you have anything you'd like to add?
No, I don't think so. At this point.
I'd like to call the next witness, Mr. Drori. Mr. Drori, tell me what was your title with PD Financial?
Chief Executive Officer.
And what was your job function or job responsibilities with PD Financial?
Please speak into the microphone.
Overall responsibility was managing the corporation, including strategic partnerships, financial modeling, and overall day-to-day operation.
Do you have a responsibility and or knowledge of this, how the sales taxes were being reported?
No,
Do you have any role in the sales taxes?
no.
Whose responsibility in the company was it to handle sales taxes?
CFO and a team of 7 people that work under him were preparing quarterly sales tax return. I'd like to emphasize that for 20 quarters, all taxes were paid on time, both federal and state, and for the best of my knowledge, until the company ceased operation, they were all paid on time.
Okay, and I asked Mr. Molina a question regarding a statement by Mr. Chow that Mr. Grant, that he believes Mr. Grant went to you guys, you and Mr. Molina, to ask the priority of certain payments of the second quarter sales tax. Do you recall Mr. Grant asking you what should be paid and what priority with respect to the second quarter sales tax?
No, I'd like to emphasize that the company that at the time generated nearly $20 million a month in revenues, had at the discretion of the CFO to prioritize payables on a regular basis. This was never the case that such small amounts, again, relative to the turnover of the company, would go to my attention. There were basically quarterly budget reviews. In those quarterly budget reviews, we would typically sign off on a budget, but I was not involved in the day-to-day disbursement of payables to vendors or tax authorities.
Can I quarterly budget? What? I didn't get the last word.
There was a quarterly budget review, and I was not involved in the daily disbursements of cash to vendors or tax authorities. It was handled by the accounting department. I mentioned again that the company that turned turnover of nearly $200 million a year. The sales tax portion was a very small part of the overall expense, and therefore it was under the CFO, financial controller, and accounting department to process that on a regular basis.
And did you believe the sales taxes were being paid at all times?
Yes.
And when did you learn that there was an issue with the sales tax?
About probably the first week or second week of November. I can't recall the specific date of 2009. It was brought to my attention that although all sales tax were paid through Q3, there was a leftover from Q2 that was not paid. At the time, the corporation was out of business and out of resources.
And I think there's some statements somewhere that in the appeals decision that somehow you did not have, that you could not recall when you learned about it. Is that accurate, or do you recall?
I recall that it happened, like you said, first week to second week of November of 2009.
Is that why? How do you know it was about that time?
Because it was after the termination by the bank partner of the financing agreement. That was the time that we determined that the company ceased operation. And we had a meeting, I recall that, to review where we're at, and that was one of the topics that was brought up based on my request and my question. Where are we? Do we have any outstanding issues? And I was told that our sales tax initially were paid through Q3. I was told that our payroll taxes were paid, or payroll were paid, but then later on it was brought to my attention that there was a second quarter amount that wasn't paid. And when I asked why, the people said that they believe that it would be subject to offset due to returns and cancellations, which is the reason why they haven't paid for it. That is what they were told.
Anything else you'd like to add?
I'd like to add, yeah. So in our line of business, we would learn about cancellations sometime 30 and 60 days after the fact. And those cancellations would typically come from the bank partner. A customer will request to close their account sometime within 60 days after the initial sale. And in that case, our obligation to the bank partner, at that time it was ADS, or World Financial Capital Bank, was to refund the customer's purchase and reverse at that point, or obviously, the sales tax. So since those things happened in the rear, there were a lot of pending cancellations that were in the pipeline, and I was told at the time that the team believed that there would be enough cancellation to offset 100, or I don't remember the exact amount, $1,000 of sales tax. Again, I'd like to remind everyone that at the time, the volume that we generated was in the range of $20 million a month, and the sales tax portion for the state of California was probably about 1% of that turnover.
I have no further questions at this time.
All right. Does that conclude your presentation?
Yes.
So before I go any further, does the department have questions for these witnesses?
No, we do not.
Does my panel have questions?
I did have one or two questions, I think for Mr. Molina, President. It was referenced, mentioned that there was embezzlement by Dan Grant, the former CFO. Was he fired for that?
The answer to that was ultimately he left the company. He was not fired immediately because we were in the midst of trying to raise capital, and the prospect of raising capital with no CFO was problematic. So what we did was we docked him, we took back substantial equity that he had had, a variety of things in conjunction with our outside counsel.
Okay, and when did he end up leaving the corporation then?
When the company closed.
Oh, so would that have been October, November, do you know?
October of 2009.
Okay, and when the embezzlement was discovered, was there any additional oversight given to the CFO?
The answer was yes, there was oversight given, particularly with respect to instructions to Shiva, who worked for him. The area in which the embezzlement had taken place was basically his taking advances. Wisely from his point of view, because it turned out not to avoid any criminal action, he actually posted them on the books. And ultimately, I think we believe gave Pricewaterhouse an erroneous statement with regard to what activity had taken place in the company's books. So the answer is yes, there was substantial oversight with regard to anything that he could take for himself. It did not change, because there had been no indication that anything had gone wrong with respect to how he was dealing for the company. It was only with respect to self-dealing, and that was the area in which that we created substantial additional oversight.
Okay, to shift gears a little, there was some reference, I think, in the ACMS notes to, for PD Financial as a possible, I'm not sure if it was a DBA as Peachtree Direct or
Yeah,
the venue.
there's of course, it's difficult for us reading notes that were taken by a third party from yet another third party statements. The reality is that the way that is reflected is no way that Dan ever would have talked about the company. What appears to be the case that somehow or other Dan is making a distinction between Peach Direct's operations and PD Financial. What I think, knowing what the reality is, I think in fact what Dan was saying is PD Financial still exists. It hasn't been terminated. We haven't, done anything to eliminate or end its corporate existence. The company still exists. But the reality is that the only function that the company had, the only business that we were in, we had no other subsidiaries, we had no other lines of business. The only business we had was the Peach Direct / venue business, and he was quite clear in that statement, in that phone call, that in fact had already terminated, consistent also, by the way, with what Shiva had been telling other representatives of the board during the period of about a month before that phone call. So the answer is that Venue was a DBA. We had an online website called venue.com. Peach Direct had been an earlier, that was the reason for PD. Peach Direct had been an earlier brand name, but the reality is that all of the company's business terminated in October of 2009. The only thing that remained was the corporate existence.
Okay, so the venue was an online DBA for PD Direct, but that also terminated, is that?
That's correct. The company's entire business terminated in October of 2009, and that in fact is what Shiva specifically explained to the people that had called her. Yes, we're out of business. And ultimately, when they tried to reach her, they couldn't because the phone lines had been cut.
Okay, I did have one question for CDTFA. Did you want me to wait until their presentation, or just related to this? Or?
They might answer in the presentation.
No, go ahead. So I was just curious about that ACMS note because from 12/16 with the conversation from Dan Grant, my understanding of the note, it indicated that CDTFA researched that the venue was still an active DBA for PD Financial, and so I was confused about that, and it did indicate that a letter was sent out within a couple minutes of entering that comment. So does CDTFA have any other evidence to indicate what was discussed during that phone call, or is all you have that ACMS note?
Essentially, we have that ACMS note where after the phone call with Mr. Grant, where he indicates that Peach Direct ceased operations, but that the business was continuing as Venue. That department employee, pursuant to our ACMS notes, did some online research and found venue.com, I believe, as a viable website, and that's essentially what we have from that phone call and that activity on that date.
Your Honor, may I add something? The note that he is referring to said that the individual involved had done some additional research and was able to confirm, A, that the business was still operating, and B, still being financed by ADS. The reality is, and you've got it in your evidence package, the reality is that ADS formally terminated the relationship. Formally and technically terminated the relationship on November 11th, long before whatever that research was, in fact, had been done. So whatever the research was clearly faulty, since ADS was no longer funding anything and Venue.com was no longer in business.
Okay, yeah, I was basically just trying to understand what was, if that conversation resulted in the term, I guess the corporation reporting the termination of the business or not. That's why I was asking to see what other evidence there wasn't that. That's why I was asking that question. Thank you. I think I answered my.
Maybe a point of clarification on this issue.
If you, go ahead, if you want to say anything.
I just see in the ASIM the reference to the website access on November 13, 2009. It says try to access www.peachtreedirect.com, but to get additional information, website declined to show the web page. I'm not sure if there was a statement that she tried to access venue.com.
That's what they've said.
That was an ACMS note on December 16th, 2009.
So let me save that till you get into your presentation, so we don't have it twice.
Could I do one more point of clarification? With respect to Daniel Grant and the taking of the funds, Mr. Molina, is it my understanding that there was some agreement for him to pay them back or to resolve that issue?
The answer is yes. There was both a termination of all of his equity in the company. There was a settlement agreement that required him to be repaid, and he did in fact, out of compensation, begin to repay us. We had in fact anticipated the possibility of criminal charges, but after the consultation with counsel, we were advised that that was not appropriate.
I just want to follow up a little bit with Mr. Drori about his testimony that he did not have any involvement in paying sales taxes or vendors. To what level of oversight would you say that you had in this, and what level of detail would you say you heard in the meetings that you described regarding those kind of payments, let's be specific, payments of sales taxes?
So anything that considered repeatable payments, such as cost of goods sold, sales tax, was handled directly by CFO and his team. Thing that out of the ordinary, that would require my approval, would consider things that are not repeatable, such as new business, new bank agreement, a bonus to an employee. The things that are part of normal day-to-day operation will not be managed by me. This is why we had a big team of accountants that will process that. And I'm sure, Your Honor, you would imagine that any large corporation that has a CEO, I do not believe that the CEO is involved in the daily preparation of account payable and sales tax returns. And the same applies here.
Were you presented with documents that confirmed to you that taxes had been paid? And, did you see it on a list each month or each quarter?
I would not get every day or once a week, but I would be presented once a quarter with a financial statement that suggests that all taxes were paid. It's typically done in the rear. You get it typically a month and a half after the close of a quarter. So in the case of Q3, I would typically see that by, let's say, middle of November, which is 45 days after closing of a quarter.
So in 2009, if we're looking at, say, the second quarter of 2009, you'd be in the third quarter of 2009 when you would have received that financial statement.
That's correct.
So do we remember anything about what happened during that period?
No one ever reported to me that there is unpaid taxes at the time. It was simply part of a quarterly statement, and it only shows here's what paid, but it doesn't show what is not paid. I get to see a balance sheet, and I get to see a P&L, and in the balance sheet, it typically will show me if there is any reserved, let's say, funds for payroll taxes or sales taxes, and in the normal course, all I would see is basically one line item on a balance sheet that says reserve. And at that time, I was never reported that there is a missing payment. In fact, there is a payment, as much as I recall, in Q3. I believe Q3 payroll taxes were paid in full. So I found it a little bizarre that after the corporation ceased doing business, we found that there is an unpaid balance from Q2 when I was reported that Q3 was paid. So I'm not sure exactly how that happened.
I think that's all I have.
I didn't mean to not give the microphone to my colleague. I didn't want to drag it past my computer, but then I saw the court reporter's look, so I would be giving the microphone from now on. I just have two, go ahead.
Before you move on to them, I was going to ask one more question for the taxpayers. Since you had submitted that return as an exhibit, I was just wondering, is there any dispute with respect to how the liability was calculated, or are you only disputing elements of 6829?
Just the elements, but are you asking why the third quarter tax return was submitted?
I guess I was just wondering if there was a dispute with that.
No, the reason it was, just to clarify, the reason it was submitted is the board had somewhere stated that Ty Reber wasn't, his job function wasn't involved in sales tax, and the third quarter shows he signed that return.
Okay, understood. Thank you.
So I have just two questions. Well, it starts off as two questions. When and how did you discover, I guess it's okay to call it embezzlement. When and how did you discover the embezzlement of Mr. Grant? And whoever knows the answer can. What non-formal
Yes, so one of the representatives on our team came to me and suggested that the CFO is using my credit card, which was a corporate card that I was a guarantor of, without my knowledge. I then approached the VP of Finance while Mr. Daniel Duran was out to lunch and asked her if she knows anything about it. First she mumbled and she denied it, but then when I pressed her, she admitted, yes, I'm aware that he's taking private trips to the Bahamas with his kids on the credit card. I'm aware that he has paid for other personal expenses on your credit card. And after I continued to press her, I asked her, are you aware of anything else that may happen here? And then she suggested, well, there is that account. I said, what do you mean that account? Well, he's been taking some advances. And she said, are you talking about a one-time situation or ongoing? She said, ongoing. And she said, well, maybe I should not be talking about it, you should be talking to him. I asked again, may I see that account? And for about 10 minutes, she printed about 20 pages that probably show hundreds of transactions of $1,000 to $1,500 at the time, that total about $780,000. I, at the time, owned about 53% of the company. I was the major shareholder, and Mr. Molina had another, probably 30% of the company. It was not a public company, it was a private company, so that is basically money out of our pocket. I then waited for him to come back from lunch. I approached him in the elevator alone, and I didn't even have to say much. He already knew what I'm about to say, and I have a feeling that he was tipped by his lieutenants. The same people that threw me under the bus right now are the same people that cooperated with him, knew about his embezzlement. Needless to say, we hired a private investigator to try to find the money. We asked him to stay home and basically put him on a leave. And then, unfortunately, we found out that as a result of the fact that he put that on the books and recorded that as advances, we didn't have a cause to press criminal charges. And then we worked a deal with him to repay back the money that he was taking. And I think we were able to recover maybe 25 or 30% of it over time until the corporation basically went out of business.
What time frame did that discovery happen when you were in the elevator and talking
I
to this
think
VP?
it happened in March or April of 2009. And we obviously got out of business by November, end of October of that year.
And then there was a reference to a PwC, PricewaterhouseCoopers.
Yes.
PwC audit, when did that happen? And for what period did they
The
audit you?
PD audited 2007, 2008, and I believe
we went out of business in 2009.
Yes, and we went out of business in 2009, but what happened, I believe, that PwC issued a letter, which is what they do with every vendor that declare what money owed. He forged my signature on that letter, acknowledged that that is an advance account. So we never knew that that exists until after the fact.
Okay, thank you. I don't have any other questions. So after a little bit of delay, we'll turn it over to CETFA.
Thank you. I'm going to start with the timeliness of the notice, and then I will go into the elements of personal responsibility. Revenue and Taxation Code, Section 6829, Subdivision F, provides that a notice of determination must be mailed within 3 years after the last day of the calendar month following the quarterly period in which the department obtains actual knowledge of the termination, dissolution, or abandonment of the business of the corporation. Here, the department issued the notice of determination to appellant on April 26, 2013. Accordingly, to be timely, the department must have learned of the business termination, dissolution, or abandonment no earlier than January 1st, 2010. As shown in the Automated Compliance Management System, or ACMS notes, found in Exhibit D, page 142, the department contacted PD Financial's landlord on January 25th, 2010. The landlord informed the department that PD Financial vacated the premises on January 8th, 2010. While appellant argues that the department obtained knowledge of business termination in December 2009, the facts do not support this conclusion. The department was aware that PD Financial was experiencing financial difficulties. In Exhibit B, page 55, Mr. Molina sent an email to PD Financial's CIO, Joan Loof. That email is dated November 24th, 2009. In that email, he says that the company was attempting to resume active operations within 45 days. Another ACMS note shows that Daniel Grant and Shiva Barami told the department that the business was planning on closing. And that's Exhibit D, page 144, where Ms. Barami on November 10th, 2009, stated that the business had no money and that employees were on a 2-week furlough. Exhibit D, page 52, is another ACMS note where Ms. Barami on November 13th, 2009, stated that Peach Direct was closing business operations later that week, and Mr. Grant on that same phone call stated that Peach Direct didn't have funds and that the business was closing down. However, there's no indication by PD Financial or any statement to the department that constitutes actual knowledge prior to January 25th, 2010 that the business of the corporation was terminated, dissolved, or abandoned. We do acknowledge that Mr. Grant informed the department on December 16th, 2009, that's Exhibit D, page 43, that Peach Direct, the DBA of PD Financial, ceased operations on October 31st, 2009. However, Mr. Grant also stated that PD Financial's was continuing on with a new DBA at Venue. We note, pursuant to an ACMS note dated December 16, 2009, Exhibit D, page 43, what I referred to earlier, that after speaking with Mr. Grant, that department employee researched PD Financial and confirmed that Venue was the new DBA and that Venue's business was the same as Peach Direct's business, which was, as we've already heard, a private label credit card with online catalog sales. There was also a letter to PD Financial's creditors dated January 22nd, 2010, which is in Exhibit B, page 61, where Mr. Molina states that despite efforts to keep the business open, it was clear that the business was not able to resume operations and was going to go forward with a liquidation of its assets. This is evidence that the business of the corporation, which was the sale of consumer electronics through a private label credit card, did not terminate or dissolve until January 2010. We understand that Sales did not happen after October 2009, but the business continued, and with attempts to secure other lines of financing. There's also evidence that there's a little bit of confusion, I think, in the record about when Peach Direct ceased or when Venue began, and perhaps they were operating at the same time. It's not really clear, but there is evidence. There is letters on Venue letterhead from October of 2009. There are invoices issued under Venue letterhead in June 30th, 2009 and July 1st, 2009. Those are all in Exhibit B, pages 11, 27, 28, 56, and 57. Accordingly, the department did not obtain actual knowledge that the business of PD Financial terminated until January 25th, 2010. Based on all of this evidence, the notice of determination issued to the appellant was issued timely within the applicable statute of limitations. Now on to Section 6829, personal liability. A person may be held personally liable for the unpaid sales and use tax liabilities of a corporation pursuant to Revenue and Taxation Code, Section 6829, if the following elements are satisfied. First, the business of the corporation must be terminated. Second, the corporation must have collected sales tax reimbursement on its sales of tangible personal property. Third, the person must have been responsible for the sales and use tax matters of the corporation, including the filing of returns and the payment of tax. And fourth, the person's failure to pay the tax must have been willful. As we've already discussed, there's no dispute as to the first two elements. So moving on to the third element, responsible person means any person having control or supervision of, or who was charged with the responsibility for the filing of returns or the payment of tax, or who had a duty to act for the corporation in complying with any provision of the sales and use tax law when the taxes became due. And then initially we note that there is no dispute that appellant was PD Financial's CEO for the duration of PD Financial's existence, including the second quarter of 2009. As PD Financial CEO, appellant had authority and a duty to direct the affairs of the corporation, which includes the duty to act for the corporation in complying with the sales and use tax law. Moreover, in a phone call with the department on March 7, 2013, Exhibit D, page 94, Mr. Grant stated that he met with appellant every week to discuss what payments needed to be made, and that during these meetings, he provided a report to appellant and Mr. Molina of how much money was in the bank and what expenses, including sales tax liabilities, needed to be paid. Mr. Grant repeats in an email dated March 9, 2013, found in Exhibit B, page 13, that he met with appellant daily to discuss PD Financial's financial matters. In their business operations questionnaires, Ms. Barami, who is the VP of Finance, and that's in Exhibit B, page 36, and William Chow, the Controller, found in Exhibit B, page 45, both stated that appellant was one of the individuals who had control, supervision, or responsibility or duty to act for the business in sales and use tax matters when the business terminated. In a phone call with the department on March 7, 2013, found in Exhibit D, page 93, Joan Loof, who was the CIO, stated that appellant controlled every single penny of the company. In an email dated March 9, 2013, in Exhibit B, page 59, Ms. Loof states that appellant was actively involved in the daily management of the business and that he oversaw the daily cash flow. Based on this evidence, appellant was a person having control or supervision of PD Financial sales and use tax matters, or that he had a duty to act for the corporation in complying with the sales and use tax law when the taxes at issue became due. That was July 31st, 2009 through the close of the business. As to the fourth element, a person's failure to pay is willful if the person had knowledge that the taxes were not being paid and had the authority or ability to pay the taxes but failed to do so. As to knowledge, PD Financial's tax liabilities originate from a sales and use tax return for the second quarter of 2009 that was filed without the payment of tax owed. Accordingly, the earliest appellant could have knowledge of the unpaid sales tax for the second quarter of 2009 is July 29, 2009, when the original return was filed without payment. In a phone call with the department on March 7, 2013, found in Exhibit D, page 96 and 97, Mr. Chow stated that when he filed the second quarter return, he asked Mr. Grant how much he could pay with the return, and Mr. Grant told him that he needed to ask appellant and Mr. Molina. Mr. Grant later told Mr. Chow that the payment priority was payroll, then payroll taxes, and then sales taxes. In a letter to the department dated February 15, 2010, found in Exhibit B, page 12, Mr. Grant states that he was aware of the unpaid sales taxes and that he prepared reports detailing the liabilities for appellant and Mr. Molina. During a phone call with the department on March 7, 2013, found in Exhibit D, page 94, and followed up in an email to the department dated March 9, 2013, found in Exhibit B, page 13, Mr. Grant states that he met with appellant daily to review the payments that were due that day, that he would provide appellant with a report of the status of money in the bank and what expenses, including sales tax liabilities, that needed to be paid, and that appellant and Mr. Molina would authorize which payments he could make. In a phone call with the department on January 14, 2013, found in Exhibit D, page 106, Mr. Molina stated that he and appellant always made sure everything was paid on time and that they had to pay printers and vendors, and eventually the corporation ran out of money. In a phone call with the department found in Exhibit D, page 93, and followed up with an email to the department dated March 9, 2013, found in Exhibit B, page 58, Ms. Lou states that appellant was actively involved in the daily management of the company and that appellant controlled every single penny of the business. These facts establish that appellant was involved in financial matters and decision-making for PD Financial. Combined with the fact that PD Financial was experiencing financial difficulties, as shown in various places that have already been pointed out, specifically in Exhibit B, pages 55 to 58 and page 73, and also, as was referenced earlier, that Mr. Grant was caught essentially embezzling over $700,000. And the agreement, I'll point out the agreement that was signed, we have in Exhibit B, page 62, that was signed at the beginning of July 2009. There's also reference to it in Exhibit D, page 88. Based on all of these facts, the financial difficulties, the fact that the CFO was caught embezzling almost $800,000 from the company, it's not believable that appellant left Mr. Grant unsupervised to handle the corporation's financial matters. Based on the foregoing, appellant had actual knowledge that the second quarter 2009 taxes were not paid as of July 29, 2009, when the return was filed without the payment of tax. At the very least, appellant had actual knowledge as of October or November of 2009, as he stated in his responsible person questionnaire, found in Exhibit B, page 33. As to authority to pay the taxes, appellant was PD Financial's CEO, and there was no dispute that he owned the majority of PD Financial stock. At the appeals conference, which was, notes were included in ACMS, found in Exhibit D, page 20, appellant stated that he had the authority to tell someone to write a check to pay a liability. In a phone call with the department on January 14, 2013, found in Exhibit D, page 106, Mr. Molina stated that he and appellant always made sure everything was paid on time. In an email to the department dated March 9, 2013, found in Exhibit B, page 13, Mr. Grant states that appellant was a signer on the business bank account. And in a phone call with the department on March 7, 2013, found in Exhibit D, page 94, Mr. Grant stated that appellant and Mr. Molina authorized which payments he could make. Based on this evidence, appellant had the authority to pay the taxes or to cause them to be paid. Finally, as to ability to pay the taxes, PD Financial had funds available to pay the taxes, but instead used those funds to pay other creditors. In a phone call with the department on October 1st, 2009, found in Exhibit D, page 148, Mr. Grant stated that the financial institution backing their private label credit card, which was ADS, had high credit losses, so PD Financial had to use the collected sales tax reimbursement to pay ADS to offset those losses. At the appeals conference, again found in Exhibit D, page 19, the ACMS notes state that appellant stated that he, along with Mr. Molina and Mr. Grant, decided to pay employees instead of other creditors in fourth quarter 2009. Bank statements show funds available for July 2009, found in Exhibit H, page 12, August 2009, Exhibit H, page 15, and September 2009, Exhibit H, page 38. PD Financial made payments to one of its vendors, Synex, I think it's pronounced, on August 6th, 11th, 31st, September 16th, 23rd, 30th, and October 7th and 15th of 2009, and those are found in Exhibit I, pages 3 and 4. PD Financial's merchant settlement reports show monthly sales of over $3 million for August of 2009, shown in Exhibit J, page 15, and over $3 million for September of 2009, found in Exhibit J, page 35. Finally, EDD annual reconciliation statement shows wages paid of over $1 million in third quarter 2009 and $377,000 in fourth quarter 2009, and that's in Exhibit L, page 4. This evidence shows that there were available funds to pay PD Financial's tax liability for the second quarter of 2009 from the time that the tax was due on July 31st, 2009 through the end of the fourth quarter of 2009. But the funds were paid to other creditors instead. Appellant has presented no documentary evidence to dispute this evidence. Based on the foregoing, the department has met its burden of proving that appellant is personally liable for PD Financial's unpaid sales tax liabilities for the second quarter of 2009.
Okay, thank you. Questions from my...
I guess I did have one question, and if I'm understanding correctly, I think the taxpayer had basically some concerns with relying on the statements by Mr. Grant or some of those people, the basis that, depending on what they say, they could be on the hook for his liability too. So I'm just curious if the CDTFA either billed or informed any of these other people, like as Mr. Grant or anyone else, that for 6829 responsibility, if they issued a billing to any other person besides the two people here.
Sorry. We had just a conversation about potential confidentiality issues. No other dual determinations were issued aside from the ones that were issued to Mr. Drori and Mr.
Okay, and if I'm understanding correctly, only Mr. Drori is still on duly.
Correct.
Okay, thank you. No further questions.
Just one question. Thank you. Mr. Baucus, when you were referring earlier to some of the ACMS notes that you're arguing show that the appellant's knowledge, for example, I'll just point to one. I believe it's the ACMS record dated March 7th, 2013, that indicates that the controller asked the CFO, Mr. Grant, and this is in an ACMS note recorded by a CDTFA employee,
Correct.
who spoke with the controller, who said that he spoke with the CFO, who said that he spoke with the appellant.
Correct.
And the appellant reportedly described a payment priority instruction that put payroll first, then payroll taxes, then sales taxes.
Correct.
But you are describing it as if we knew that this conversation actually happened, as described in the ACMS note, where the CDTFA employee described what the controller said, that the CFO said, that appellant said. Correct?
Correct.
And obviously, we know that hearsay is admissible, but in terms of how much we can rely on the accuracy of the employees, assuming the employee typed very correctly, do you see my concern about describing that conversation happened versus accurately describing that the employee recounted what the controller said, that the CFO said, that the appellant said?
I do.
All right. So how much should we be relying on, we'll start with that note, for example.
Ultimately, I guess how much you rely on the evidence provided is up to you.
Understood.
We feel, the department feels that evidence is something that is likely to have happened, given the rest of the evidence that was presented about the financial difficulties and the fact that the CFO was caught embezzling money, that such an interaction would have happened in a reasonable business environment. And so we believe that that taking all of the evidence together, there is more than adequate evidence to show that appellant had knowledge that the taxes were not paid.
I think that was my only question. Thank you.
And you stole my question. I have no further questions. You have a 10-minute or up to 10 minutes to rebut, if you like.
With respect to following up on Your Honor Brown's question, with respect to the reliance on a statement from William Chow as to how a conversation happened, kind of hearsay upon hearsay, I would like to point Your Honors to Exhibit 3, which is a signed declaration under penalty of perjury, which I believe holds much more weight under if the rules of evidence did apply in this forum. And it's very clear that as to the responsibilities, I think that counters a little bit as what to William Chow said happened. Also, the testimony of the parties sitting here open to cross-examination and credibility to be determined by Your Honors versus statement, a note to third party to double hearsay. So I'd just like to address that point. Also, there were statements that the government stated that appellant Mr. Molina, Mr. Drori, I believe Mr. Molina met with Dan Grant weekly or daily meetings with Mr. Grant. Mr. Drori, were there any daily meetings with Mr. Grant regarding the finances of the company? No. Regarding who to pay?
No.
Mr. Molina, were there any daily meetings with Mr. Grant regarding the finances?
No, there were not.
About who to pay, what to pay?
There were not.
Also, I'd like to, Mr. Drori, tell me about venue and when there was some issue about venue being a new DBA, a new operation. Tell me about the name Venue.
Venue commenced operation as a DBA in January of 2007 and was an active website. Pitch Direct was not an active website since 2007. You can look at that as it's available online. A statement by ADS that made a public statement that Venue launched in 2007 in connection with signing a multi-year agreement with ADS. So that is public knowledge. I'd like, if I may, Counsel, to just mention that if I was directing to pay first payroll, then payroll taxes, and then sales taxes, how do you explain that there are millions of dollars that were paid by Mr. Grant to other vendors outside of that direction? you'll see that there is probably $6 or $7 million after Q2 that were paid among them to many vendors. So if my direction was to pay those 3 items, he definitely didn't follow my instruction then. Mr. Grant, I believe, has tried to escape any responsibility in this case and roll it on me. And I would take my responsibility as this court determined, but I will tell you that the daily decision of cash disbursements, of sales tax filing were not made by me, a CEO of a $200 million company. It was made out of an accounting team that was very skilled with daily responsibility to manage that, and I did not authorize every day and every penny as discussed here. If that was the case, I wouldn't be able to see $700,000 missing. So there's a lot of conflicting statements here that unfortunately came from an attempt by such an individual, I believe, to roll the responsibility. I'm going to take whatever my responsibilities as this court may determine, but the facts are the facts, and I believe our counsel did represent here our position with respect to the facts.
Also, another I think point of clarification: the government's counsel made repetitive points to the evidence with respect to the funds in the bank accounts in June, I think July, August, September. But it's the testimony in our position here that Mr. Drori didn't learn about this until early November, when there was not sufficient funds to pay. And so all of this, I'm not sure the relevance of showing there's funds before the knowledge of appellant. Anything else you'd like to add?
Yeah, I just want to say the same point. If there was $6 or $7 million, and probably much more than that since March, probably $15 or $20 million, and I knew that this is my personal responsibility, would I let other things get paid and avoid paying $100,000 of sales tax, whether it's 7 or 8 million or 10 million after that? Why would I do that? So there's a lot of conflicting statements here that unfortunately are not consistent with the reality. And the evidence is that up to that point, in that second quarter, every dollar was paid on time to the tax authorities, both with respect to sales tax and to the federal taxes. So it's not a pattern. It's unfortunately, in my opinion, oversight. There was a change in controller right around the second quarter. I believe it fell through the cracks, and by the time the team found out about it, they did report that to me after the company ceased operation, and simply there were no additional funds available to pay for it. And anything other than that, in my opinion, was simply an attempt to roll it to my door and take no responsibility by a CFO that unfortunately doesn't have exactly a very credible history.
Mr. Molina, is there anything you'd like to add or clarify?
You know, the only thing, going back to the venue issue, I think that it makes clear that there was a misapprehension, at best, a misapprehension on the part of the person who was talking to Dan Grant. Dan, knowing that venue had been used since 2007, would not have made a distinction between, well, you know, Peach Direct is over, but now venue is, PD Financial is going forward with venue. Dan would obviously have known that venue and Peach Direct, all of that was what terminated in October of 2009.
If that concludes your rebuttal,
Yes, Your Honor.
and the panel has no questions, you have no questions for the witnesses? All right. So at this point, I will close the record and we will conclude this hearing. These were good arguments from both parties. We have our work set out for us up here. I'd like to thank everybody for coming in today, and following this hearing, my co-panelists and I will discuss the evidence and argument, and we will issue a written opinion within 100 days. I believe we're taking a 10-minute break, is it, or 5, or how long do we do?
We should come to the parties, because it needs to be a long case, I'm not sure if we should start now or...
Okay, we'll take at least a 10-minute break. So thank you, everybody, for your presentation.
Thank you.
Thank you.
To the Office of Tax Appeals, my name is Andrew Flee, and to my right is Daniel Cho. To my left is Teresa Stanley, and we will be the administrative law judges who are deciding this appeal. OTA is a separate and independent agency from CDTFA, and our role is basically to conduct and decide this appeal. So in a few minutes, we're going to go on the record. By on the record, I mean the certified shorthand reporter is going to transcribe what is said today. But before we do that, I'd just like to go over a couple of housekeeping matters. I understand there's only one witness today, which is Andrew Vitosich. Is that still correct?
Yes, from the opponent's side, that's correct.
Okay, and no witnesses for CDTFA?
Correct.
Okay, and the CDTFA, any objections to the testimony from Andrew Vitosich as a witness?
No. We actually, before you begin, we want to get a couple of things clarified.
Okay.
First, this letter, we just want to make sure appellant was not trying to make this as evidence on record.
Oh yeah,
just for the party's information.
I was going to get to that next round, basically right now, actually.
Oh, okay.
Yeah, if you'll just give me a moment, and then when I finish going through the procedural items, if there's anything I forgot, you can, let me know. So I'll start with CDTFA's exhibits. So I understand CDTFA has the exhibits A through H, basically what's listed on their exhibit index. Are there any new exhibits beyond that?
No.
Okay. And for the taxpayer, I understand that you have the exhibit list that was submitted most recently, I think on October 14th, with the documents identified on the updated exhibit list. Is that correct?
Yes, we have the original declarations and attached authenticated documents that were submitted as part of our brief, which provides the initial part of the document list, and then the additional submission of the additional documents under item 6 on our exhibit list.
Right. Okay, so the most recent document that came in this morning, is this, what is the intent of this document?
During my testimony, I intend to refer to that document and actually authenticate and admit.
Okay, so I guess I would tentatively identify it as Exhibit J, and at this point, I would turn it over to CDTFA to see if they have any objections. But
Exhibit 7?
It's appellant's exhibit, so
Yeah, we could call it Exhibit 7.
Yeah, so you call it Exhibit J.
I guess I have the exhibit list for the
That's the CDTFA.
appellant, I guess the last exhibit I saw was Exhibit I under 6B. So I'm not really sure what number to use. I could call it 7 if that's easier.
My prepared stipulated to be Exhibit 7. That's right.
Oh. Okay, well, we call it
Make sure you're not putting it on our side.
Oh, yeah. I'll mark it.
We have no problem with any identification with that, but we do have a problem with this being so late, and so we'll be beyond the deadline for submitting evidence. And this, when I look at it, is just basically all arguments in there. It's not any factual evidence other than the fact that there was a letter drafted.
Okay, so I'll correct it to mark it to identify it tentatively as Exhibit 7 based on the numbering system 12456 with the most recent being supplemental document, and number 7 being this FAA document, and I'll address the admissibility of this when we go on the record. So I'm just marking it for identification as Exhibit 7 at this point.
Because I am prepared to testify to it and authenticate it and state its purpose.
Okay. And so, as for the other exhibits, I'll start with CDTFA. Do you have any objections to any of the other documents identified on bullet points 1 through 6 of the taxpayer's exhibit list?
No objection.
Okay. And for the taxpayer, does the taxpayer have any objection to exhibits A through H on CDTFA's exhibit index, aside from what was previously ruled on during the motions and briefing process?
The only thing we'd like to point out is that the description of the documents is inaccurate. For example, Exhibit A purports to be the aircraft purchase agreement. The aircraft purchase agreement is not only the one-page main body of the agreement, but is also the additional attachments to that agreement, which are attested to, authenticated, and included in our declarations submitted as part of our opening brief. So I don't have necessarily an objection. The description is not accurate. It is not completely.
Okay, so this is the exhibit index is not going to be the evidence, it's just the way that the documents are marked for identification. The evidence, of course, would be the exhibits that are actually referenced below.
Then in relation to Exhibit A, for example, it is a one-page document. The actual agreement as authenticated by the uncontested declarations of the parties is actually this one page and the attachments to it.
Okay. So I guess I'm just wondering, so do you have an objection aside from the title that was ascribed to the documents?
Well, as we have testified as part of our opening brief, and as I will testify also during my testimony today, the agreement was a one-page document, but the three attachments that were included in it were cross-referenced to the agreement.
Okay.
So I'm objecting to the characterization on the part of the department as to that being a complete and fully integrated agreement between the parties to the extent they choose to do so. It's not a complete submission. Also, for example, the declaration that they are submitting for me from August 20th, 2015 is only the body of the declaration. It does not contain any of the exhibits that were attached to that declaration. So again, it is incomplete.
Okay, would the parties have a concern that if I just state that the titles the titles aren't being considered evidence as to basically what the underlying documents are, but we're just taking this as for use as working documents for identification without ascribing any meaning to the titles in the exhibits? Is that would the CGTFA take objection to my making that statement?
We're okay with that, but just to point out obvious, the exhibit index, the name of the exhibits are lifted from the documents themselves. We look at exhibit A, it says in the subject line, aircraft purchase agreement. So we did not mix this up and distort the nature of the document.
Okay, so I guess if I just make a clarification that the titles on the exhibit index aren't evidence, would that be sufficient to clarify the concern?
Not for me, Your Honor. I mean, it goes to the essence of my objection, but I just want to be clear that those documents are not complete. The complete documents are contained in our submissions, and I'm fine with that, as long as those are the documents we're referring to. So when the parties refer to the purchase agreement, we're referring to the single-page main body and the three attachments that were incorporated therein, not the single page.
I think this is going more towards argument than to just the exhibit. Our exhibit is the one-page exhibit and can be used as we choose to use it. And of course, the appellant can argue what he says is the entire agreement. That's why we're here.
Right. Okay. So at this point, I think I've heard enough of this issue. That the exhibit index basically is not the evidence. It's just a means for us to conveniently refer to the documents. I'm not sure if there's concerns with the underlying documents. You can address those at the time of your presentation. But basically, I'm not going to take an objection to the exhibit index itself. I'm only looking to see if there's objections to the documents, and the objection that we will take is whether it is relevance or privilege. And if you have a concern with the relevance or the privilege of the underlying documents that were submitted by CGTFA, now's your chance to raise it for those two aspects.
That's fine. I understand where Your Honor is actually clarifying. We will raise our objections as and when the department uses the documents.
Okay, great, thank you. With that being said, I'll briefly go over the exhibits when we go on the record and the objections. So with that, I would just briefly do the time estimates. The parties, would you, at this point it's almost noon, the parties, would they like to go for a lunch break, or do you think the parties would like to just push it through and take lunch after the presentations and hearing is concluded today? Do you know at this point?
Just as soon as understand.
Okay.
And that's fine with me, Your Honor.
Okay, so then I would basically try and conclude this as efficiently as possible. Please keep that in mind yourselves. It's going to be a long day today. I believe we're ready to go on the record. One last issue. So we have PowerPoint presentations. I realize this is an aid. I just want to make sure CDTFA did not have any objections or concerns with the PowerPoint presentation, and that you also have a copy of the PowerPoint presentation.
We don't have a copy of the PowerPoint presentation, but we can view the PowerPoint presentation.
Okay.
And I just assumed that was on there besides arguments. There are no new exhibits or anything. I assume it's everything we've seen.
Yes, is everything you've seen, yes, that's correct. During my testimony, which will also have a PowerPoint presentation, I am seeing a new document for later.
And we'll discuss that. Yes.
Okay, great. So we are ready to go on the record. We're now opening the record in the appeal of Snowflake Factory LLC before the Office of Tax Appeals. The OTA case number is 1805-3161. And today's date is Tuesday, October 29th, 2019. The time is approximately 11:50 a.m. And this hearing is being convened in Van Nuys, California. For the record, will the parties please state their names and who they represent? We'll start with the representative for the taxpayer of Snowflake Factory.
My name is Andrew Massich, and I am the founder and manager of Snowflake Factory LLC.
Okay, and for CDTFA?
Richard Mayer for CDTFA.
Monica Silva for CDTFA.
And Lisa Renato, CDTFA.
Okay, thank you. So today's hearing is being heard by a panel of 3 administrative law judges. My name is Andrew Kui, and I am the lead judge. Judge Teresa Stanley to my left and Daniel Cho to my right are the other members of this tax appeals panel. All judges are going to meet after the hearing today and produce a written decision as equal participants. Although the lead judge, myself, will conduct the hearing, any judge of this panel may ask questions or otherwise participate in this appeal to ensure that we have all the information necessary to decide this appeal. So the documentary evidence marked for identification includes exhibits A through H, which are described in CDTFA's exhibit index, and the taxpayer's evidence consists of the documents described in its October 14th, 2019 exhibit list, which are documents bullet points 1 through 6. And in addition, there is exhibit documentation that was submitted today, a document submitted today marked as exhibit, marked for identification as exhibit 7. CDTFA has objected to this document, which is titled Self-Report Concerning Registration of the Following Aircraft. And the objection that was raised by CDTFA is that this was submitted after the deadline. At this point, CDTFA is going to sustain the objection and exclude this document as evidence on the basis of our Regulation 3420, which provides that exhibits must be submitted 15 days before the hearing, and also on the basis that the deadline specified in our municipal orders, we have a deadline of October, we have a deadline before this was submitted, basically 15 days before the hearing. This document was submitted basically on the day of the hearing, so it's untimely. However, the taxpayer is free to refer to this document, make the arguments mentioned in this document during their presentation. This document does appear to most of the argument, which could be referenced in the presentation by the taxpayer. But with that said, we are going to exclude the physical document from the evidentiary record, which would be the documents listed in the taxpayer's exhibit index, exhibits 1 through 6, as the evidence marked for identification for the taxpayer. In addition, there were also some objections that were ruled upon during the briefing process, and there was one additional objection that the taxpayer had raised, which was to the titles of the documents listed in the exhibit index, but the taxpayer is going to be addressing those arguments at the time of the hearing. They were more towards whether the documents are correctly summarized. OTA informed the taxpayer and the parties that the exhibit index titles are not evidence, it's the documents underneath that are evidence, so we're not excluding any of the documents for CDTFA's exhibit list at this time. So please, will the parties please confirm if I gave an accurate summary of what was discussed? CDTFA, did I give an accurate summary of what was discussed just now?
Yes, thanks.
Okay, and Mr. Matosic, have I given an accurate summary of what was discussed before we went on the record?
Yes, sir.
Okay, thank you. So the above evidence, with the exception of Exhibit 7, is now admitted into the oral hearing record. Just to confirm, the city TFA, you have no further objections to any of the taxpayers' exhibits?
Correct.
Okay, and Mr. Matosich, you have no further objections at this time to the city TFA's exhibits?
Again, as we stated before going on the record, I'll raise my objections during the argument and presentation of the documents.
Okay, thank you. So there is one issue that's going to be decided today in this appeal, and that is whether California use tax applies to appellate storage, use, or consumption of the aircraft. And in resolving this issue, the parties have raised several different arguments that will also be resolved and addressed in the written decision. So with that said, I believe we're ready to proceed with the taxpayer's opening presentation. I'm not going to swear you in at this point because you've reserved time afterwards to do your testimony. So at this point, you just may proceed with your presentation, Mr. Matosich.
Thank you, Your Honor. My hope is that the Wi-Fi connection will be good enough to allow the iPads to cycle through the presentation. If that is not the case, please let me know. I do have paper copies of it, and I will leave it behind when we are done for the benefit of the panel and for the counsel for the CDTFA. So, the first question is, why are we here? 5 years into this, why am I sitting here? Why are we in hell? Why are we still discussing this issue? And the best way I could describe it to myself and my wife was, no good deed goes unpunished. This was supposed to be a very simple transaction between a seller of an aircraft, a buyer of an aircraft. The seller was an Oregon company, the broker was an Oregon broker, the airplane was an Oregon plane. It was supposed to be purchased in Oregon. That was the essence of the deal. And as I will describe, and as our testimony has already testified to, the deal just went awry and became compressed in terms of time, and last-minute changes had to be made. And that is the source of the issue that is before the panel right now. My hope is that this presentation will make it eminently clear, and that the credibility of the witnesses who have testified under oath, myself and 4 others, will make it very clear, as a matter of undisputed fact, that this matter can be resolved as a question of law. And secondly, to the extent that there is a factual issue for this panel, that the overwhelming evidence is in favor of the intent of the parties, which governs the transfer of title in the state of California, was that the intent was to transfer title in Oregon, which was done in Oregon. So in summary, is the presentation changing? Is it?
We're at presentation summary right now?
Okay. The undisputed facts in front of this panel, as we sit here today right now, is the title could not have transferred in the state of California because the appellant came into neither actual nor constructive possession of the aircraft in the state of California. Now, even if those facts, which should not be disputed, are disputed, the overwhelming evidence is clear that it was the intent of the parties to transfer title of the aircraft, not in California, but in the state of Oregon. And that the parties did, in fact, do so. If this panel should, however, find, either as a matter of law or as a matter of fact, that title did transfer in the state of California, the aircraft is still exempt from both sales and use tax. It was functionally used outside the state of California, and it returned to California and is exempt from use tax on the basis of the interstate commerce exemption in 1620B5C3. Stepping back to 2015, on or about January 20th, 2015, I, as the manager of Snowflake Factory, became aware of an aircraft that was being offered for sale that was then presently in Ontario, California. I went to Ontario, California to see the aircraft. It had not yet been advertised. There in a hangar in Ontario is the aircraft. This photograph was not actually taken in Ontario, but is representative of the aircraft in the state that I saw it on August 20th, 2015. When I was there, at the aircraft on behalf of Snowflake Factory, a gentleman by the name of Mike Stevens introduced himself as the president of Fleet Planes, Inc. He indicated to me that he represented the seller, MV Forger, a company that I understood at the time to be involved in the production and distribution of cutlery.
I'm sorry, do you mind if I break in here? I believe you're testifying as to the facts, so I'm not sure if it might be helpful for me to swear you in at this point so that we could actually rely on this as evidence, the statements that you're making.
Judge Cui, if you would like, you can certainly swear me in, but all of this has already been testified to in my declarations, the declaration of John Burnett and the declaration of Mike.
Okay.
Mike Stevens.
I apologize. If you're just summarizing the evidence that's in the record, then you may proceed.
Thank you. As Mike Stevens has actually admitted in his declarations, he was involved in this transaction between Snowflake Factory and MVF. John Barnett, in his declaration already before the panel, has confirmed that he was known to him to be in the business of selling aircraft, and that he had done business personally with Mike Stevens and Fleet Planes, Inc. in the past. As I testified in my declaration, I knew that Fleet was in the business because Snowflake had been looking for aircraft for some time. And we saw many advertisements in publications like Controller, where Fleet would advertise aircraft, expensive aircraft, for sale in the state of California. This particular advertisement is actually from March of 2016. Unfortunately, Controller does not go back to 2015, but I will be testifying this afternoon that I saw advertisements exactly like this in 2015 in advance of the sale at issue here. Furthermore, filed with the Secretary of State in the state of Oregon in 2015 is an amended annual report on behalf of Fleet Planes, Inc., indicating that its business was aircraft sales. So between January 20th and January 22nd, Fleet and Snowflake hammered out the essence of the deal between MV Forger and Snowflake Factory. The aircraft, simply stated, owned by MVF, was to be transferred to Snowflake Factory in the state of Oregon, with Fleet acting as the broker. Is it tracking?
I think Alani message is calling you. I'm just going to decline the call.
I'm sorry, yeah, but it should be on the Do Not Disturb. I apologize, Your Honor. Are you still on the presentation?
We're good now, thank you.
I'm sorry, I apologize.
Just 1 minute, maybe I'm going to call.
I apologize.
Okay, we're good now.
Okay, I'm sorry. Then on January 23rd, the agent for the seller, for the Fleet Planes, Mike Stevens, notifies Snowflake that the owner of the aircraft, MVF, wanted to do a hurry-up 1031 exchange. And they wanted to close their exchange on the 27th of January. That was not the initial contemplation of the parties. Again, the original transaction was supposed to be MVF to Snowflake in the state of Oregon. Very clean, very clean. The problem with meeting the demands of MVF was that it was expected at that time that the aircraft would still be sitting in California. It was undergoing pre-purchase inspection corrections to make it airworthy and capable of flying on return to flight. As I testified in my declaration, I objected to this proposal. John Barnett confirms that I objected to this proposal. The seller emphatically states that we would not agree to take title or delivery of the aircraft in California. But we only had 2.5 days to figure this out, over a weekend. So So the original contemplation was that NBF would sell the plane directly to Snowflake that day. It was suggested by John Barnett, and he testifies to this in his declaration, that Fleet interpose itself between NBF and Snowflake that day. Fleet would purchase the aircraft from NBF, and then, as the seller himself has stated, it was the intent that Fleet would then hold the aircraft and complete the sale to Snowflake Factory in Oregon. The problem is that Fleet didn't have the money or the available cash, or so we were told, to complete the transaction. So John Barnett, who was involved in the transaction at this point in time, because he was going to be designated as the seller's forwarding agent to effect delivery, suggested that Snowflake loan the money to Fleet to complete the transaction. Snowflake agreed, but we wanted a full set of loan docs. These bullet points are summarizing testimony already on the record in the form of the declarations of myself, John Barnett, and the seller. Fleet declined. Mike Stevens wanted to keep the deal very simple, limited to one page. That was his MO. Since escrow had already been opened, John Barnett contacted the escrow agent to see if, in fact, there wasn't a way the deal could actually be handled in the context and contours of the existing already opened escrow. And it was the escrow agent that suggested using the FAA bill of sale as a security instrument, as a security document, to secure the loan from Snowflake Factory to Fleet. This has been attested to not only by John Barnett, not only by myself, but specifically by the seller himself in the declaration. The FAA bill of sale was to be used as a security instrument for the loan from Snowflake Factory to Fleet until such time as Snowflake Factory inspected and accepted the aircraft, which was by contract specifically to occur in Portland, Oregon, as originally contemplated between NBF and Snowflake. So the deal that was reached between recipient parties to the transaction, the purchaser, the seller, and witnessed by John Barnett, as testified in his declaration, was for Snowflake Factory to make a loan to Fleet. Fleet would purchase the aircraft from NBF. NBF would transfer its ownership of the aircraft to its then broker Fleet in the business of selling aircraft. Fleet would then return and would give a bill of sale to Snowflake Factory with the stated intent and agreement that it was simply to act as security until such time, if ever, as Mike Stevens has already testified, if ever, Snowflake Factory accepted the aircraft after inspection, after delivery. As the declarants have already testified, and is part of the record, the seller was obligated by contract to complete the sale by delivery of the aircraft to Portland, Oregon. Snowflake had no right to possess or control the aircraft until delivery, inspection, and acceptance. Barnett would be immediately appointed to be the forwarding agent by the seller, under the seller's control and authority, ownership of the aircraft. And only upon the mutual signature of the delivery certificate incorporated into the purchase agreement would ownership of the aircraft pass, as and when attested to by the parties and notarized as the agreed form included in the contract requirement. At the time the agreement was reached, the parties understood that this transaction was to be a sale on approval. By that, they understood that after inspection of the aircraft, Snowflake had the right to reject the aircraft for any reason. And so on January 26th, as the declarations of John Barnett, the seller, and myself have already attested, the actual purchase agreement was agreed and exchanged and executed. And in that I apologize, my keynote has just failed. I apologize. Are your screens active?
We're on the first page of the presentation.
Go back to the first page of the presentation.
Previously.
Right, and
Now
now?
at a different place.
Okay, so this is where I left off before it crashed. I apologize. So in that agreement, signed on October 26th, the parties agreed that there would be 3 attachments regarding significant terms in the agreement. So the agreement is not just one page. The agreement is the principal terms of the agreement in the main body, the one page that Mike insisted on. It had the additional 3 attachments. Those attachments were a work order by Landmark Aviation, which is now Technicare, Signature Technicare in Fresno, California, for all of the work that was to be concluded by the seller. There was an appointment of agent form confirming that John Burnett would be appointed as the forwarding agent of the seller, the owner, to transfer the aircraft to Oregon and to execute the aircraft delivery certificate, or aircraft delivery receipt, we call it the delivery certificate, which was also specifically referenced and incorporated into the purchase agreement. So the text that is being highlighted here in the purchase agreement shows all of those relevant points. The seller was responsible for completing the work order work as a condition of the agreement. The seller was obligated to deliver the aircraft to Portland, Oregon. The seller was required to engage John Barnett. The delivery of John Barnett was authorized, the seller was required to authorize and did authorize John Barnett to execute the delivery certificate specifically referenced. And the seller acknowledged in the agreement that the risk of loss was his or its until purchaser takes delivery and physical possession of the aircraft. Return now to the delivery certificate. Stated in the delivery certificate is confirmation that the aircraft was required to be delivered in Portland. In the delivery certificate is stated the right to inspect the airplane by Snowflake Factory. It may be unartful, it may not be as clear as all lawyers might like, but it's right there. Acceptance, also a condition of the agreement, attesting to the fact that Snowflake Factory had the right to reject the aircraft, is set forth in this delivery certificate, again incorporated into the agreement. And critically, is the language confirming that ownership would transfer only upon the signature by both parties, notarized as to location and identity of the parties signing below. And so it was on January 26th. The explicit agreement of the parties that the seller was obligated to complete the sale by delivery of the aircraft to Portland. Snowflake had no right to possess or control the aircraft prior to delivery, inspection, and acceptance. The bill of sale was only a security instrument, and only upon mutual signature of a delivery certificate in the form incorporated into the agreement and the written agreement by the parties executed on January 26th would ownership transfer. And so it was on the 27th, the date by which MV Forger insisted that its portion of the now new reconstituted agreement be closed. That as had been agreed by the parties, Snowflake made the loan to Fleet. Fleet acquired the aircraft. Ownership of the aircraft was transferred from MVF to Fleet, and Fleet granted a security instrument consistent with the intentions of the parties, consistent with the understanding that the delivery certificate would control. The security, the FAA bill of sale was simply used as security, holding the pink slip like for a car. It's important to this analysis to point out that Snowflake never came into possession or control of the aircraft in the state of California. That is already on the record in the form of the declarations in front of the parties, or in front of the panel today. John Barnett was appointed the agent on the 26th, not the 27th, on the 26th. Before any transaction happened, the aircraft, control of the aircraft was transferred to John Barnett to prepare the aircraft for delivery and delivery out of state. I testified already, and I'm prepared to affirm and confirm today, if necessary, that at no time did Snowflake attempt to exercise control over the aircraft, at no time did we have the right to exercise control over the aircraft, and at no time did we exercise control over the aircraft until after inspection and acceptance in Portland, Oregon. John Barnett confirms that. And importantly, the decision itself, on which this appeal is based, says there is no dispute that the seller completed its performance with reference to physical delivery of the property in Portland. The plane was not delivered to Snowflake. Snowflake did not have possession of the aircraft, had no control over the aircraft in the state of California. Now, this is actually a video, and I apologize. In the test, it may not actually render as quickly given the limitations of the jetpack that we're using and the reception that we have in this room. I apologize, but this is actually video of the aircraft arriving on the ramp in Portland, Oregon on February 10th, 2015. I am taking this video. John Barnett, the pilot, the designated forwarding agent for the seller, is sitting in the cockpit. Are we tracking? I apologize.
I saw it for this.
I apologize. And so after the aircraft arrived in Portland, and only after the aircraft arrived in Portland, did I, who had flown there commercially, and I have testified to this as well, I flew there commercially. If I owned the aircraft, I would have been on board. But I flew there commercially to inspect and hopefully accept the aircraft. John Barnett confirms this in his declaration. Only after his arrival in Portland, Oregon, did I inspect, ask about the airworthiness of the aircraft, confirm the records that were on board the aircraft, and accept that aircraft as airworthy and consistent with the plane that Snowflake was willing to acquire. And only then did we go inside and sit down before a notary of public in Portland, Oregon. I believe it was on the ramp in Atlantic Aviation in Portland, Oregon. We sat in the conference room and executed this delivery certificate. It confirms that ownership of the aircraft transferred from seller to buyer on the date written below. And as Barnett and I have testified already in our declarations, it was only then that Snowflake received the keys to the aircraft. One of the declarations in front of you is a declaration by Tom Johnson. He is the insurance broker that first issued insurance on the aircraft for Snowflake. He has testified, based on his preliminary understanding of the transaction and the agreement between the parties, that there was not an insurable interest in the aircraft until Snowflake either came into possession or ownership of the aircraft, and therefore would not issue insurance on the aircraft until I called him from Portland, confirmed to him that we had accepted delivery of the aircraft, acceptance of the aircraft, that ownership had transferred, and it was only then that Air Power issued the insurance certificate on the aircraft. After the aircraft had been inspected, accepted, after the delivery certificate had been signed and notarized, it was only then the aircraft then had its first functional flight and flew from Portland, Oregon to Glacier Park International in the state of Montana. That again is attested to in the declarations that are before you. The department, in the decision below and in our pre-conference hearing, has conceded the question of whether or not the use of the aircraft subsequent to its first entry into the state of California complies with the interstate commerce exception of 1620 B5C3. That is not an issue for this panel. The questions on appeal here, as succinctly summarized by Judge Cui, effectively is use tax owing? But as part of that, the question is, as the department has framed in its argument, is where did title transfer? Title is both an issue of law. What is title? What are the constituent parts of title to make title under the law of the state of California? And as to the transfer of title, what was the intent of the parties as to where, when, and how that title would transfer? 2401 makes this very clear, and I'll be citing authority momentarily that makes that incredibly clear based on the prior Supreme Court authority in the state of California, that it is the party's intent that governs where title transfers. Now, if that is to be disbelieved, the title is still found to transfer in the state of California. The occasional use exception that this underlying decision put forth and that the department has argued here exempts this sale from sales tax transaction does not apply. It just simply doesn't apply. 6396 is, Section 6396 is the only exception that gets the aircraft exempt from sales tax in the state of California as a sale in interstate commerce. And the return of the aircraft and its subsequent use is exempt, contrary to the department's assertion. Under 6248 and 6248C, Section 6248 and 6248C, as an aircraft used in interstate commerce. So, the department relies on Section 6006 for its definition of sale as to what is the constituent elements of what a sale is in the state of California. 1610, the flip side, was a purchase in the state of California, and they rely in the underlying decision in 1610.5 as to where title transfers. The key elements are title, or possession as element number one, of a property for a consideration. I will demonstrate momentarily, or argue momentarily, that none of these elements are satisfied in this transaction. Starting with possession. The declarants, Mike Stevens, John Barnett, Andrew Matisich, have all testified that there was no attempt to exert control or possession of the aircraft, there was no right to exert control or possession of the aircraft, and there was no possession in the state of California. So under 6006, possession as an element of a sale does not apply. And in fact, the department itself, in acknowledging that the aircraft was properly delivered by the seller to the state of Oregon, acknowledges that possession did not transfer in the state of California. The next element, title. What is title under California law? In our brief, we set forth with a citation to Cal Jur 3rd summarizing the essence of what title is in the state of California. It is just, that is proper, rightful possession of property. This has gone undisputed heretofore by the department. Expounding on that, the case of Northrop versus the State Board of Education, or the Board of Equalization, said that title is ownership. All of the rights, privileges, powers, and immunities an owner may have. In our brief, we cite Parker said for the proposition that title can be divided into legal title and equitable title, which the FAA recognizes even on its own bill of sale. Critically, the Northrop Court held that title in California must be the union of the right of possession with possession. Now, as lawyers, I'm sure we're sitting here thinking, well, wait a minute. You don't actually have to physically possess something in order to actually have title conveyed. That technically is not what the law of the state of California says, and the department has at least not contradicted what I have set forth, Snowflake has set forth, is the law of the state of California. Still, it begs the question of whether or not, for the purposes of title, what constitutes title, whether or not there is a concept of constructive possession as it applies to title in these matters. Whereas the department concedes that there is no possession in the state of California, the question is whether or not there was any constructive possession. And the case of Northrop versus the State Board of Equalization is somewhat instructive on this point. In the case, Northrop and Boeing had a contract. Under the contract, Northrop kept title of certain equipment that it was using to manufacture parts for the Boeing 747. This equipment, together with the parts, would move back and forth between Northrop here in California and Boeing in the state of Washington. The deal between the parties was very complex. It dealt with a number of matters, including tax issues, but the question was whether or not there had been a sale of this equipment from Northrop to Boeing under the agreement and the facts and circumstances of the case. The court acknowledged that Boeing came into possession of the property from time to time, but it was troubled by the fact that Northrop contractually had a retention of title. And so the court looked for other indicia of what might constitute a sale, effectively putting forth the proposition of constructive possession in the state of California. The court wanted something more than simply a naked right to obtain title. It wanted to see whether or not there was absolute discretion to remove the property, whether there was unfettered power to divest the other party of legal title, unconditional obligation to purchase the property, and the unequivocal assumption of risk of the property, of loss of the property. Now, in the Northrop case, the court found all of these. Boeing had all of these, not the least of which Boeing decided to apply for with the IRS and take an investment tax credit. And as constituent of that, it was required to actually accept the proposition that it actually had the beneficial ownership of the equipment. In our case, none of these four factors apply. It's quite clear from the seller's declaration itself that we would not have any right to take possession or have control over the aircraft until it had been delivered and accepted in the state of Oregon, if ever. John Barnett confirms that he was under control of the aircraft at all times. So Snowflake did not have the absolute discretion to remove the property from the other party. It was committed to John Barnett on the 26th. John Barnett remained in control of the property and was under instruction from the seller, the owner of the aircraft, to deliver that property to the state of Oregon. Similarly, we did not have the unfettered power to divest the other party of title. As the contract makes it very clear, there was a delivery certificate that had to be acknowledged before ownership were transferred. That is what the delivery certificate says on its face. We did not have the power to compel the seller to sign the delivery certificate, nor were we under an obligation to sign the delivery certificate if the aircraft, for whatever reason, was not acceptable. We also, for the very same reason, did not have the unconditional obligation to purchase the property. This was a sale on approval. The seller acknowledges in uncontroverted testimony before this panel, this was a sale on approval, that Snowflake Factory had the right to reject the aircraft for any reason. Finally, the face of the one-page main body of the agreement makes it clear on its terms that the seller remained at risk for loss of the property. So, if the law of California is that constructive possession is allowed in addition to absolute possession, Northrop is instructive. Applying Northrop to the facts of this case, even under these additional 4 rigorous criteria that Northrop set forth, Snowflake did not have possession or constructive possession of that aircraft in the state of California. And absent possession, title does not exist. You must have both. In a similar vein, on the question of property, in the case of General Dynamics Corporation versus the County of LA, which was referenced in the Northrop decision, Justice McComb, in a concurring opinion, basically said that ownership is the right to possess and use. We did not have the right to possess. We did not have the right to use. The right to use is critical under a use tax analysis. We did not have the right to use the aircraft in the state of California until after delivery, inspection, and acceptance in Portland, Oregon. Finally is the question of consideration. Annotation 495-0468 is a question of basically what appears to be a related company transaction where an aircraft owned by Company 1 was being transferred to Company 2, 2 parties, and it was effectively a transfer for no consideration, being transferred from one to the other for the convenience of the parties. The potential taxpayer in that case specifically asked the department, in reference to an FAA bill of sale, whether or not, if in transfer of that property, there was actually no consideration, despite the requirement of a recitation of consideration in the bill of sale, whether or not that would actually constitute a sale. The department was emphatic on the point. As long as there is no consideration, it doesn't matter what the face of the FAA bill of sale says. There is no consideration, and the sale fails for lack of consideration. In our case, I'm sorry, has it hung up? I apologize.
Mine is no longer displaying.
I can, let me see if I can restart the program.
Sure, maybe I apologize.
unfortunately, it does not seem to be initializing. It's on my screen. There we go.
Great, thank you.
Mr. Matisich, would you mind going back to the prior screen because Judge Clee's screen dropped out before I brought that one up?
Yes, let me see if I can actually do that.
There's no need if it's going to bring up the presentation.
Right, you may proceed.
I'm sorry. I'm relying on the good offices of Apple and Keynote. Did it appear on the screen? Are you seeing the annotation on 495?
Yes.
Okay, great. The point I was making was that in this annotation, the taxpayer, potential taxpayer, asks about whether or not, despite the formalities of the FAA bill of sale, whether or not, if there is absolutely no consideration, whether or not a sale occurs. In fact, there is a transfer using an FAA bill of sale as an actual transfer of title as opposed to a security instrument, whether or not there would in fact be a sale. And absent consideration, there is no sale. And so this is where it crashed. It crashes again, I apologize. But so in this transaction, there was no consideration between Snowflake and Fleet. It was a loan. It was a loan for Fleet to purchase the aircraft from NVF. And the FAA bill of sale was simply security. So as a matter of law, title did not transfer to the state of California. The state has conceded that we did not have possession. Snowflake did not have possession of the aircraft in the state of California. Possession is critical not only for a sale on transfer of possession, but is critical for a sale on title transfer. It is a constituent element of title in the state of California. We did not attempt to control the aircraft in the state of California. We did not have the right to control the aircraft in the state of California. So absent possession and even constructive possession on the basis of a Northrop analysis, or the facts of this case, there was no possession in the state of California. And as a result, no title. Again, just summarizing the Northrop case, we lacked the absolute discretion to remove the property, the unfettered power to divest the other, the legal title, the unconditional obligation to purchase, and the unequivocal assumption of risk. Under Justice McComb's analysis, we also lacked property because we didn't have the right to use the property. And there was no consideration given. The Form FAA bill of sale was a security document. Consistent with the law of California, which I'm going to turn to now, the intent of the parties was that document was a security instrument. Now the state is likely to say this is preposterous. The bill of sale, on its face, says that the seller is the full legal and beneficial title owner of the aircraft. That by signing the instrument below, that it is conveying all rights, title, and interests in and to the aircraft. Snowflake is prepared to stipulate that if the department wishes to treat the FAA bill of sale and its four corners as the complete and fully integrated agreement between the parties as to the transfer of title under California law to the aircraft, we will, in full satisfaction of our obligation for sales and use tax, pay the tax based on the considerations set forth on the face of the FAA bill of sale. I'll take the dime out of my pocket right now and pay it. And it'll be done. I wager, however, that the department is not so prepared to stipulate. I mean, this is a serious offer. Is the department prepared to stipulate or no? This is not theatrics. We are prepared to stipulate that this is the four corners of the agreement. as the department has argued for the past 5 years, if this is the full sum total of the agreement between the parties, we will pay our tax on the considerations stated on the face of that document in full satisfaction of our obligations, and we're done, we can go home. Will the department so stipulate? I'm sorry?
I thought this was argument.
Yeah, I'm
Argument.
sorry.
But as part of my argument, I believe I'm entitled to actually offer up a stipulation and settle this case right now, am I not?
We can refer during the department's presentation if they want to address at that point, but at this point, I think we should just proceed with the presentation as opposed to sidetrack with sidebars. If that's okay, we can.
All right, that's fine, but it's a valid offer that I'm making now. There's a procedure that I'm unaware of. I apologize. I'm not represented by Drori Council today.
If the parties would like a recess to discuss this, I don't think there's a need to break at this point.
The department does not intend to respond to that.
Okay.
So contrary to California law, which makes it very clear that the instrument, the agreement between the parties, which the department has put forth as being the FAA bill of sale, is the sum total of the agreement. The consideration stated in that agreement, I doubt very much that the department will be willing to stipulate to that, because much more is stated in the actual purchase agreement for the aircraft. The taxpayers' rights advocate opinion, which we have submitted as part of our additional supplementation, acknowledges the difference between a document of title and title itself. And that's really what this FAA bill of sale is. If it were the sum total of the agreement between the parties, if the four corners of that document were the complete agreement, then tax would only be due on the consideration. But we know that it is not. The department acknowledges, or should acknowledge, that it is not. As the first district held in a recent case, the City of Fontana versus the Department of Tax and Fee Administration, documents may be important, even dispositive, but should not be a litmus test, nor should the four corners of that document become a fetish. I argue, for the past 5 years, that's what the FAA bill of sale has been in this matter. The purchase agreement sets forth a much higher level of consideration, which is why we are sitting here today based on the tax on $1 million versus the $1 recited consideration in the FAA bill of sale. And it is in recognition that one must look beyond the four corners of the FAA bill of sale is why we are sitting here. What the department in 5 years has not been willing to consider, although the documents have been in front of them since the first filing was made in August of 2015, is the delivery certificate and its intended effect, its agreed effect, and ultimately its effect upon signature of the parties. The only people who are actually participants in the underlying transaction at issue. In Portland, Oregon, only there will ownership transfer. And that is the only place where, in fact, ownership, title under California law, did transfer. If the panel is disinclined to see that as a matter of law, based on undisputed fact, the title could not have transferred in the state of California, and that it is a disputed matter of fact, it is the clear state of law in the state of California that it is the intent of the parties that governs when title will transfer. In the same Fontana case, this recent case, the court is very clear that Section 2401 governs the question, or is properly referred to by the department and here at the Office of Tax Appeals, for determining how to determine when, where, how title transfers. In fact, the decision conducts an analysis of 2401 and concludes that While 2401 is informative, it does not necessarily overrule any of the prior case authority in the state of California. And it is that prior authority in the state of California that makes it very clear that intent of the parties governs when, as an issue of fact, when title transfers a property between buyer and seller. Here the seller has stated that Snowflake would not agree to take title in California. The seller confirms the intent was for the seller to complete the sale in the state of Oregon. And emphatically, the seller declares that the FAA bill of sale was not intended to convey complete title from the seller to the purchaser. It was acting only as a security instrument until such time as Snowflake accepted the aircraft. The intent of the parties is further evidenced by the agreement itself. The written agreement, summarizing the parties' agreement, reached over that fitful weekend of trying to solve the issue we confronted, was delivery was to be required in Portland. The seller was required to appoint a forwarding agent, which it did on the 26th. The seller remained at risk for all loss until acceptance. Snowflake, the purchaser, was not obligated to accept the claim, not entitled to control it, not entitled to possess it, and free to reject it. And the parties made very clear in that written agreement, by virtue of the delivery certificate and its explicit language, that ownership, title, would only transfer on mutual execution of the certificate after delivery, acceptance, inspection, and acceptance. Furthermore, the conduct of the parties shows that conduct is consistent with the intent and the written agreement. John Barnett was entrusted with the aircraft, had exclusive control over the aircraft. The department acknowledges that the seller fulfilled the obligations to deliver the aircraft to Portland, effectively conceding the question of possession in the state of California. Further consistent with the intent and the agreement, the conduct of the parties, I, on behalf of Snowflake, inspected the aircraft only in Portland. I accepted the aircraft only in Portland, and we signed the delivery certificate only in Portland. So as an issue of fact, the overwhelming evidence in front of this panel is that, based on the sworn statements of the parties, the written agreement, and the conduct of the parties, is that title was not intended to and did not transfer in the state of California. The FAA bill of sale was not a complete and fully integrated agreement between the parties. It was, by agreement of the parties, as is allowed under the state of California, it served only as a security instrument. As previously stated, we didn't have the right to control, possess, or use the aircraft. The intent was to transfer, and the actions of the parties were to transfer title only in Oregon. And we had the right to reject the aircraft for any reason. And that brings us to sale on approval. Regulation 1628B3C states unequivocally that when a sale is on approval, a sale does not occur until the purchaser accepts property. The only recipient witnesses to the transaction have testified that this was a sale on approval. The seller has acknowledged that the purchaser had the right to reject the aircraft for any reason. In the department's regulations, the sale on approval is not conditioned on any other factor. Presumably, as we argue in our brief, there is no other predicate. It's a sale on approval until acceptance. Title does not move. Title as a matter of law does not move. Title as a matter of fact does not move. Again, it is the uncontroverted testimony of the parties that this was a sale on approval. And the decision ignores that uncontroverted testimony. The decision found that it was not a sale on approval based on what it calls the purported understanding. It expected to find in the agreement a specific reference. That is not required under California law. And I'm about to demonstrate, as a matter of fact, it is there. It's there in the delivery certificate. But importantly here, the decision doesn't even mention the declaration of the seller, which was before the officer at the appeals bureau. It doesn't even take that into account. It just simply looks to the declarations of John Burnett and the purchaser. Personally, that makes me wonder whether or not the full file was actually in front of the officer at that agreement. Contrary to the decision, there is language. The language is contained in the delivery certificate. The delivery certificate specifically references the right to accept the aircraft, the right to inspect and accept the aircraft. It does not say acceptance of delivery. It says acceptance and delivery and inspection. This was a sale on approval. You can't wish it away. Uncontroverted testimony as to the nature of the agreement. The delivery certificate sets forth that right. We are under no obligation to accept the aircraft. We could have rejected it for any reason. The conduct of the parties is consistent with that understanding. And critically, under a use tax analysis, if the aircraft had been rejected, clearly no use tax would be owing. So in summary, title didn't transfer in California either as a matter of law or a matter of fact. Now, should this panel conclude otherwise, and I hope not, the evidence is clear, the law is clear, but should the panel reach the conclusion that the title did transfer in the state of California, the sale from the seller to the purchaser is still exempt from sales tax under California law, not on the basis of the occasional sale rule as the department has. It was exempt under section 6396. And the return of the aircraft back to California was also exempt under what I consider to be a proper reading of the statutory authority and regulations promulgated consistent with that statutory authority. The department admits that the seller was in the business of selling aircraft. The department concludes, however, that the seller was not in the business of selling aircraft in the state of California. The seller also, as best I can determine based on the opinion, requires that the seller be a seller under California law before any sales are subject to sales tax. This quote taken from the decision is that forth. There is no evidence that the seller engaged in or conducted business as a seller within the state. We believe that the department is in error at this point, and here's why. Section 6275A says that every person making a retail sale is a retailer, regardless of whether they're a retailer by any other reason. Section 6283 does put forth an exception for retailers who are not required to hold a seller's permit. But Section 6284 takes that away. It doesn't refer to a seller, it doesn't refer to a retailer, it refers to a person. So if a person is engaged in the business of selling vehicles, mobile homes, commercial coaches, vessels, or aircraft, then he or she shall not be excused from the requirements of Article 2, 6066, compelling that retailer to have a permit. Specifically, it denies the exception under 6283. Here, as we've already demonstrated, the seller of this aircraft was in the business. The department concedes the seller was in the business of selling aircraft. The regulation 1684C1 says a retailer is engaged in business in this state as defined in section 6203. If the retailer has a representative, an agent, a salesperson, or any other person operating in California. Based on the testimony that is already before the panel, in the declarations already submitted, when I went out to Ontario, I met Mike Stevens. Mike Stevens is the president of Fleet Plane Sales, Fleet Planes, Inc. He represented himself that he was involved in the transaction, and he did, in fact, handle the transaction. It's his own declaration attests. Furthermore, 1684C1 sets forth that a retailer is engaged in business in the state as defined in section 6203 if the retailer owns or leases real or tangible property in California. As the department itself has argued, the bill of sale setting forth who has equitable and legal title to the aircraft, the seller, attesting by this document that in fact the seller had both legal and equitable title to the aircraft on the date set forth on that FAA bill of sale, the 27th, the aircraft was in the state of California. And so at that time, the seller in the business of selling aircraft had property in the state of California. A representative in the state of California representing the transaction, property in the state of California being sold by a seller in the business, thus under 1684. The seller was engaged in the business of selling aircraft in the state of California. Furthermore, as further evidence of the seller being in business, the seller put his dealer number on the FAA bill of sale. So any person who is engaged in the business of selling tangible personal property is required to have a seller's permit. The seller was a person, a retailer, and a seller under California law. Thus, the sale at issue here is subject to sales tax. And what does all this matter? Why am I spending all this time? Why am I taking us down this road? One is to show that the department actually is in error as to its conclusion as to the status of the seller and the importance of that to this transaction, and the analysis that we must go through to determine if, in fact, title transferred in the state of California, whether or not this is a taxable transaction, and is it taxable in sales tax or use tax, and where does the ultimate tax liability lie? So, our argument has been, as we set forth in our briefs, is that 6396 is the only available exemption from sales tax, not the occasional sale argument, but 6396, sale in interstate commerce, as reflected also in Regulation 1620. And the reason for this is because the question will arise, when was the use that is triggering the use tax? When did that use occur? On January 26th, before any paperwork between the parties, the aircraft was committed to John Barnett. We had no right to control, possess, or use the aircraft. Again, the department has acknowledged this. So the use of the aircraft was not its transportation for purposes of delivery from Fresno, California to Portland, Oregon, but instead The first functional use of the aircraft occurred out of the state of California in its flight from Portland, Oregon to Kalispell, Montana, from Glacier Park International. Thereafter, the aircraft came back into the state of California. The 1620b3, of course, sets forth the presumption of use and is generally referred to as the function. I'm sorry?
You have to slow down at this point.
Oh, I
when
apologize.
you're reading that fast, just slow down just a little bit.
I
was getting it up until now, but we're good.
I apologize. I apologize. You were trying to communicate it to me. I'm sorry. I apologize. So regulation 1620b3 sets forth the first functional use test. And this is to clarify the plane leaves the state under a 6396 analysis. The first functional use is out of the state, not the delivery flight. This brings us to the final point I'll make, and then I will wrap up my presentation, is the interstate commerce exemption itself. This argument was somewhat difficult to make in our briefs, and I'm going to just try and elucidate a little bit on it, if I can, to try and make the point here. It is a technical construction issue, but it is an important issue in terms of what we view as being the proper construction of the interstate commerce exemption. 1620b1 basically says that use tax applies to any property that is basically not, that is used and does not otherwise, excuse me, that is otherwise exempt from sales tax. And 1620b5c3 says that if the property is an aircraft, use tax will, I apologize, I'm sorry, I'm trying.
So am I.
I apologize. If the property is an aircraft, use tax will not apply if 1/2 or more of the flight time traveled by the aircraft during the 6-month period immediately following its entry into the state is commercial flight time traveled in interstate or foreign commerce. Again, this has been conceded. The use of the aircraft post-entry into the state of California has been conceded by the department. The department, however, says that the interstate commerce exemption, as articulated in 1620b5c3, is inapplicable because it is predicated on where the aircraft was purchased. We disagree, and here's why. In 2004, the legislature revised Section 6248, changing from 90 days to 12 months, the heretofore generally known 90-day test. The intent, as stated in the legislation itself, and in the bill analysis of that legislation, was that the changes made in that section were not intended to apply to aircraft used in interstate or foreign commerce. So 6248A sets out the test, changing 90 days to 12 days and other provisions. But the legislature added 6248C. You know, the legislature is presumed to act with intent, and in adding C, it says this section, the entire section, shall not apply to any vehicle, vessel, or aircraft used in interstate or foreign commerce. Meaning that the predicate of where the aircraft is purchased and the period of time that it must stay outside the state for establishing the presumption does not apply to aircraft used in interstate or foreign commerce. Now, in 2004, the board redrafted regulation B4, prior 90-day test, and created B5, setting forth the 12-month test. Now, in modifying the terms from B4 to B5, either the department, in making the changes, consciously attempted to include the effect of 6248C, or alternatively, it failed to do so, and in which case the department's reliance on it is misplaced. This is not intended to be read. It's just simply to show the significance of the change from B4 to B5. The redraft was extensive. So in redrafting B4 to B5, you can see in B4, the predicate of the aircraft being purchased outside the state of California is clearly set forth in the superior clause 4. The exceptions or exemptions follow the word unless, the colon, and then we have the subordinate sections below it. That was not the case in the drafting of B5. The predicates of the 12-month test, the purchase outside functional use, set forth, but the subordinate clauses are not those of the exemptions. Subordinate clauses are those of further qualification for application of the test and the presumption. So all 4 of these qualifiers are just that, further qualifications under the initial statement of the rule. In the new B5, subdivision B is expressly and presumably intentionally not subject to the statement of the rule as it was in 4. So again, in B4, used in interstate commerce was an exemption to the stated rule. In B5, Section B sets forth as an independent and separate clause, not a subordinate clause, the manner by which you may submit evidence rebutting the presumption. But again, in Section B5, it is not subordinate to the rule. It is separate and distinct. So whereas the interstate commerce exemption in B4, prior to the modification of 6248 and the inclusion of 6248C in 2004, was clearly used in interstate or foreign commerce, was subject to test in the place of purchase. But that is not the case in the independent clause in B5. C stands alone. And in fact, if the legislative intent expressed in 6248C is to be followed and carried out as would be required of the department in enacting regulations pursuant to statute, it cannot apply because 6248C expressly takes out the 12-month test in the place of purchase in matters involved in interstate and foreign commerce, in aircraft involved in interstate and foreign commerce. And if the board had a different intention, it could have clearly stated as such, as it did in Section D, following Section C, where it clearly states, notwithstanding subdivision B5A above, aircraft or vessels, the purchase and use of which are subject to the 12-month test. It does not. I'm sorry. I apologize. I've been admonished 3 times and I apologize. So subsection D says, notwithstanding subdivision B5A above, aircraft or vessels, the purchase and use of which are subject to the 12-month test described in subdivision B5. If subsection C of 1620 B5 were intended to be subject to the predicate 12-month test and the place of purchase, the department could have and should have used the very language it used in subsection D. It did not. B5C stands on its own. So the return of the aircraft, if the panel should find that title transferred in the state of California, the plane leaves under 6396 and it comes back under 6248, 6248C, and in a proper construction of 1620, entry into the state of California is when the airplane returns. Because it leaves the state under 6396, it is not used or functionally used in the state. Therefore, its entry is not at the point of title transfer. It is at the point it returns to the state after its first functional use out of state, which is allowed under 6396. So a proper application of the exemption, as we see it, is to read Regulation 1620B, where B1 sets forth the application of use tax to property, and B5C3 sets forth the exemption for aircraft that are purchased, may be purchased within the state or outside the state, purchased and returned in the state of California, and not subject to use tax under the interstate commerce exemption. So in conclusion, this panel can find as a matter of law, based on undisputed facts, that title didn't transfer in the state of California because there is no dispute as to where possession, or even constructive possession, if allowed under the law of the state of California, occurred. Possession, we did not possess the aircraft, we did not have the right to possess the aircraft. So as a matter of law, title could not have transferred in the state of California. The department admits possession didn't transfer. Possession is a critical element of title. We had neither possession nor constructive possession. As a matter of fact, the intent of the parties governs. That's clear under 2401 of the Commercial Code, and is clear, as the First District has just made very clear in the City of Fontana case, under prior Supreme Court precedent in the state of California. It is the intent of the parties that governs. It is not the department to assert its intent or its reading. It is the intent of the parties. The seller, the purchaser, and an independent recipient witness to the transaction have all testified as to the intent of where and when title was to transfer, not in the state of California, in the state of Oregon. However, if the panel should find otherwise, again, the plain leaves free of sales tax under a 6396 analysis, and returns under what we would argue is a proper reading of 6248 in the application of 1620 B5 and C3. And that concludes our presentation.
Okay, thank you. And at this point, I'll reserve questions until you do your testimony. But before we turn it over to CDTFA for their presentation, I think the reporter might need a break. So how about we take a 10-minute break and come back at 1:25.
The paper presentation, and I was just going to object to that as not being included as evidence.
Okay, yes, I understand that the presentation would not be considered as evidence, and the panel have concerns with having a paper copy.
It wasn't intended to be evidence, but it is part of the record as to what was actually shown to the panel, summarizing the points at issue. But if you don't want a paper copy for the record, that's fine with us. We were doing it as a courtesy, as a leave behind, but for future reference, the record will reflect what was said, but it may not reflect the actual flow of the argument for purposes of recollection and reference.
Yes, so if CDTFA, do you have any objection to us, or to the taxpayer leaving a copy which would not be part of the evidentiary record, but just a document that was submitted, so as part of OTA's record?
As opposed to
evidence.
the record that we have here from Mr. Monaco.
Right,
That
so.
will be transcribed.
Right, so.
Well, I would object to the necessary.
Okay. So I'll address that when we go back on the record. So I believe we're ready to go back on the record now. So CDTFA has raised an objection to the taxpayer leaving a paper copy of the presentation which was discussed today on the basis that it would not be evidence, and the panel agrees that the document is not evidence, but we believe it might be helpful to accept as basically a document that's part of our record, just not evidence in the record. So we will allow a transcript to be left behind. Provided a copy is also provided to CDTFA and a copy provided to the court report. Do you have enough copies for that?
We only have 5 copies prepared, so if one for the panel is sufficient, one for the reporter, one for the CDTFA, so we have enough, and I can leave the other 2 behind. I would like to retain a copy for my record so that I know what we actually left behind.
Okay, I believe one copy for the panel will be sufficient.
One for the reporter, one for the panel.
Can
Yes?
I ask a question? Can you go off record?
Oh, sure, we'll go off the record for a second.
I'm not good enough to talk to anybody. Would I use record? Because it goes back to the, it goes back to the ones.
Oh, I just thought that it might be helpful for you if you missed what was
Okay, so
said.
you don't want it to be in the record itself, right?
Right,
Okay.
yeah. Okay.
That's fine.
Okay, great. So we'll go back on the record now. So with that said, I believe we're ready to move on to CDTFA's opening presentation. So you have time.
Yes, thank you. Contrary to all the arguments you've just heard, the evidence establishes that title to the aircraft passed to appellant on January 27, 2015, while the aircraft was located in California. This makes the aircraft transaction a purchase and sale in California. Because of this, the interstate commerce use provision, as provided in Regulation 1620, subdivision B5C, is not applicable, and the appellant, having purchased the aircraft from someone other than the person required to hold a California seller's permit, is liable for use tax as properly determined by the project. There are 2 main legal issues in this appeal. First, where title to the aircraft passed to appellant, such that a sale of the aircraft occurred. And second, whether the interstate commerce use provision, as provided in Regulation 1620, B5C, applies to purchases in California. First, on the issue of title transfer, Revenue and Taxation Code Section 6010.5 provides that the place of sale of tangible personal property is a place where the property is physically located at the time the act constituting the sale occurs. Since Revenue and Taxation Code Section 6006, subdivision A provides that sale means and includes any transfer of title or possession of tangible personal property for consideration, the place of sale is a place where the tangible personal property is located at the time the transfer of title or possession occurs. Further, Regulation 1628, subdivision B3D, applying the rules set forth in California UCC section 2401 and interpreting Revenue and Taxation Code section 6010.5 provides that unless explicitly agreed that title is to pass at a prior time, the sale occurs at the time and place at which the retailer completes its performance with reference to the physical delivery of the property. In other words, title to the property can pass prior to delivery if the parties explicitly agree to that. And contrary to appellant's arguments, that's exactly what happened here. Title passed prior to delivery, as shown by the following evidence. The Department's Exhibit A, the aircraft purchase agreement, so titled by the parties, shows that the aircraft purchase agreement requires in Article 1 that, I quote, close must occur by end of day 27th January 2015, unquote. In other words, the aircraft purchase agreement calls for consummation of the sale and the purchase transaction by January 27th, 2015, with purchaser having to pay in full and seller having to transfer full title to aircraft upon close on January 27th, 2015, pursuant to the aircraft purchase agreement. It's undisputed that the appellant fulfilled its end of the bargain as a purchaser and the purchase agreement by paying the full $1 million purchase price by close of escrow on January 27, 2015. The Department's Exhibit B, the FAA aircraft bill of sale, shows that, consistent with the purchase agreement's mandate that close occur by end of January 27, 2015, and to fulfill seller's end of the contracts, the parties caused the FAA bill of sale to be filed on January 27, 2015, on the day of close of the escrow. And the FAA bill of sale states in relevant part that I quote, the owners of full legal and beneficial title to the aircraft does this 27th day of January 2015 hereby sell, grant, transfer, and deliver all rights, title, and interests in and to such aircraft onto Snowflake Factory LLC, singularly the said aircraft forever, and warrants the title thereof, unquote. The language, the owners of full legal and beneficial title, hereby sell, grant, transfer, deliver all rights, title, and interests to Snowflake Factory LLC, carries such verbal plainness and distinctiveness that there is no need for inference and no room for difficulty in understanding the effect of the transfer, that the seller had both full legal and beneficial title to the aircraft, and then transferred all to appellant on January 27, 2015, retaining no rights, title, or interest whatsoever. It's hard to conceive of any title transfer provisions more explicitly than that. And based on these documents, clearly, full title, not just legal title, to the aircraft, passed from seller to appellant on January 27, 2015. And because the language in these contractual documents is clear and explicit, leaving no need for inference and no room for difficulty in understanding, it governs the transaction at issue in accordance with the California law. And whatever different understanding or subjective intent the parties now alleged had before finalizing the purchase agreement and the associated bill of sale, even if true, are irrelevant to the contract, as they were not integrated into and further contradicts the final binding legal documents before us, the aircraft purchase agreement and the FAA bill of sale, which clearly and explicitly provide title transfer, full title transfer, both legal and beneficial, on close from January 27, 2015, while the aircraft was still in California. And contrary to appellant's argument, the department never stated that the FAA bill of sale was the only contract document. Our position is based explicitly on both the purchase agreement and the FAA bill of sale. While not necessary to complete the sale, but as further evidence of the title transfer, the full legal and beneficial title transfer on January 27, 2015, and consistent with the purchase agreement and the FAA bill of sale recorded, the department's Exhibit C shows that appellant filed an aircraft registration application with the FAA dated January 27, 2015, with the FAA receipt date of January 28, 2015. The certification section of the form states in pertinent part that, I quote, I/we certify that the above aircraft is owned by the undersigned appellant, which was appellant through its manager, and the legal incidence of the aircraft, the legal incidence of the ownership is attached or has been filed with the Federal Aviation Administration. So not only do we have an explicit agreement on transfer all rights, title, and interest in and to the aircraft, including all the legal and beneficial title by seller to appellant on January 27, 2015. But also, we have appellant itself unequivocally confirming such a full title transfer and asserting its full ownership of the aircraft on January 27, 2015, while the aircraft was in California. The department notes that this FAA file copy of the registration document directly contradicts the June 28, 2008 declaration and the penalty of perjury by appellant's president. That was on page 5, paragraph 14, that the aircraft was registered with FAA on February 13, 2015. The department's Exhibit D, the Glacier Jet Center Aircraft Handling Lease Agreement, it reflects an effective date of day 1st, February 2015, which was before delivery of the aircraft in Portland and while the aircraft was in California. And it recites that, I quote, "Lessee is the owner of that certain aircraft described on the Exhibit A, and the aircraft was the aircraft at issue," unquote. Again, appellant asserted that it was the owner of the aircraft on a date while the aircraft remained in California before the out-of-state delivery. The department's Exhibit E, the declaration by appellant's manager and member dated August 20th, 2015, also confirms that the title passed in California. Specifically, paragraph 9, page 3 of the declaration states, I quote, "As the aircraft purchase agreement states, solely for the convenience of the seller, Snowflake took title to the aircraft while the aircraft was still undergoing its post-pre-purchase inspection corrective work in Fresno, California," unquote. This statement confirms that appellant's member and manager, an experienced attorney and a sophisticated business person by his own account, understood that title transferred on January 27, 2015, and that was required by the purchase agreement via the mandated close date of January 27, 2015. And two, the parties in fact did fulfill the contractual requirement, and the appellant took title in California. Similarly, both departments' Exhibit A, the aircraft purchase agreement in paragraph 2, and the Exhibit B, the FAA aircraft bill of sale on the funding stamp on the right, indicate that escrow on the transaction was handled by Insured Aircraft Title Services, Inc., which touts itself on its web as the world's leading aircraft title and escrow company, facilitating the buying and selling of aircraft around the globe each day since 1963. So the fact of the escrow company's filing of the FAA bill of sale and the timing of such filing by close of escrow and its close of escrow on January 27, 2015 are all evidence that the escrow company, a well-known, experienced title company specialized exclusively in the aircraft transaction, was informed by the parties of the parties' actual mutual intent and agreement to require not only full payment by appellant, the purchaser, but also title transfer, full title transfer by seller upon close of escrow, with no contingencies and possibilities for any alleged sale on approval or sale upon delivery or any other reason. In addition, the party's choice of the form for the escrow to file with the FAA, the bill of sale, instead of an equally simple and short FAA form, which is called Aircraft Security Agreement. It's also only one page with a certification at the back. For filing security interest, also clearly indicates that the party's instructions to the escrow was to cause full title transfer, not merely recording the security interest. Otherwise, they would have instructed the escrow company to file the security interest one-page form. And escrow company obviously could only act upon the mutual agreement of the parties, and they did carry out that parties' agreement accordingly. Last but not the least, appellant's various declarations also make it clear that the closing deadline of January 27, 2015 was mandated without room for negotiation whatsoever in order for the prior owner to qualify for a 1031 exchange. Such a circumstance makes it imperative that the complete sale occur on January 27, 2015, leaving no room whatsoever for the possibility of a sale on approval on delivery. The above evidence clearly establishes that all rights, title, both legal and beneficial title, and the interest to the aircraft passed from seller to appellant on January 27, 2015. Therefore, a sale within the meaning of Section 6006, Subdivision A occurred on January 27, 2015. And this is true irrespective of when, where risk loss cost, or when insurance or other responsibility of ownership and the purchase agreement cost. All the evidence I just discussed also directly refute appellant's arguments that the transaction was a sale on approval or a sale on delivery, or that the FAV of sale only transferred the security interest. And since it's undisputed that the aircraft was in California on January 27, 2015, the January 27, 2015 sale and purchase of the aircraft occurred in California, and the appellant owes use tax as the department has determined. Turning next to the issue of the applicability of the interstate commerce use provisions of Regulation 1620, Subdivision B5C. Regulation 1620B5, on its face, provides that Subdivision B5C is not an independent clause, as appellant asserts, but it's a subordinate provision of Subdivision B5, which applies only to aircraft purchased outside California. Accordingly, the interstate commerce use provision is not applicable to this appeal because, as I just discussed, the aircraft sale and purchase took place in California. And more specifically, contrary to appellant's argument, the first sentence of Subdivision B5, paragraph A says, as relevant here, I quote, except as provided in Subdivision B5D below, the provision of Subdivision B5 apply, unquote. This opening sentence makes it very clear that only Subdivision B5D is accepted from B5, and that B5C is not accepted from coverage by B5, applicable only to aircraft purchased outside of California. This is also clear from the regulations organization that Subdivision B5 is organized by first providing a rebuttable presumption in B5A of an intended purchase in California for those out-of-state purchases brought in California, and then providing ways to get out of the presumption in Subdivision B5B and B5C. This is further confirmed by the plain text of Subdivision B5C itself, which provides, I quote, if the property is an aircraft, use tax will not apply if 1/2 or more of the flight time traveled by the aircraft during the 6 months period immediately following its entry into this state is short flight times traveled in interstate commerce, interstate or foreign commerce, unquote. The provision of a 6 months period, 6 months test period for aircraft starting immediately following its entry into this state obviously requires that the aircraft be first out of the state when purchased. Similarly, the last sentence in Subdivision B5C states, I quote, such use, that was referring to the use in interstate commerce, will be accepted as proof of an intent that the property was not purchased for use in California, end quote. This proof of intent language clearly speaks against the presumption of an intended purchase for use in California as set out in Subdivision B5A in the same regulation for aircraft purchased outside California. In other words, Subdivision B5C's own regulatory context and language provide that it does not stand on its own, but instead is tied to other subdivision B5 provisions regarding the presumption for out-of-state purchases, and that it functions as one way to regard that presumption in intended purchase in California. The text and organization of the subdivision is also clear and is consistent with the regulatory background. As appellant stated, subdivision B5 was added as a new subdivision in 2004 to Regulation 1620 to implement SB 1100, which amended Section 6248 of the Revenue and Taxation Code to provide the 12 months test for vehicle, vessel, aircraft purchased outside of California. The amended Revenue and Taxation Code Section 6248 subdivision C provides that, I quote, this section shall not apply to any vehicle, vessel, or aircraft used in interstate or foreign commerce pursuant to regulation prescribed by the board, end quote. The reference about the regulation prescribed by the board for interstate and foreign commerce use, that's a reference to the provisions the department added to Regulation 1620 between 1999 and 2002, which incorporated an interstate commerce use component to the analysis of whether an aircraft, vessel, or vehicle purchased out of state was nonetheless considered purchased for use in California to be subject to California use tax. The fact that the department's regulation on use tax in the context of the interstate commerce has always only applied to out-of-state purchases is made very clear by Regulation 1610, the regulation dealing specifically with vehicles, vessel, and aircraft, which states in subdivision E, that's Regulation 1610, subdivision E, that I quote, out-of-state purchases of vehicle, vessel, and aircraft. Regarding the applicability of tax to the out-of-state purchase of a vehicle, vessel, or aircraft, see subdivision B of Regulation 1620. End quote. The rulemaking file in 2004 for Regulation 1620B5 took note of the statutory mandate that no change be made to the board's existing regulation on interstate commerce use, and states, I quote, as the amended statute seeks to make no change to the applicability of use tax to vehicles, vessels, or aircraft used in interstate or foreign commerce pursuant to board regulation, new subdivision B5C reflects the language of existing subdivision B4B of Regulation 1620. Such a clear regulatory context leaves beyond a doubt that there's no distinction whatsoever between subdivision B4B and B5C of Regulation 1620 relating to the interstate commerce use. Since the appellant agrees that B4 only applies to purchases outside of California, and since both the underlying statute and the rulemaking file for Regulation 1620B5 both explicitly say to make no change to the board's existing regulation on use interstate commerce, there can be no distinction whatsoever between Regulation 1620, subdivision B4B, and B5C, contrary to appellant's assertion. So it's clear that the interstate commerce use provision is not applicable to appellant's aircraft purchase in California. Lastly, regarding appellant's other miscellaneous arguments. Appellant's argument that this is a sales tax transaction fails because Revenue and Taxation Code Section 6283 and the Regulation 1610 C2A provide that the sale in this state of an aircraft is exempt from sales tax when the retailer is other than a person required to hold a California service permit. Instead, the purchaser must pay use tax. The key language overlooked by appellants is being required to hold a seller's permit pursuant to Article 2, commencing with Section 6066 of Chapter 2. Section 66, application for permit, provides in subdivision A that every person desiring to engage in or conduct business as a seller within this state shall file with the board application for a permit for each place of business. In this case, the department is not ignoring that the seller sold aircraft, and the department is also not arguing this sale is exempt from sales tax because it was an occasional sale. That was never the department's position. But that in and of itself does not mean the seller was required to hold the California seller's permit, given that the permit requirement I just discussed is also tied to a place of business in California. Here, the seller wants an out-of-state business, and there's no evidence that the seller had a place of business in California to be required to hold a California seller's permit. Therefore, this transaction, even though a sale in California is exempt from sales tax, but instead, the transaction is subject to use tax as the department properly determined. In addition, regardless of whether the exemption under Section 6283 and Regulation 1610 C2A applies to the sale of the aircraft in California here, as the appellant argued, that's the only argument we actually agree, given that the contract requires delivery at the destination out of state, and delivery was actually made out of state, the sale in California, even if not exempted by Section 6283, would still be exempt under Revenue and Taxation Code Section 6396 and Regulation 1620 A3B for sales in California. That exemption applies where the tangible personal property pursuant to the contract of sale is required to be shipped and is shipped to a point outside of this state by the retailer. But Section 6396 exemption does not help appellant, contrary to his belief, because this exemption applies only to sales. In other words, it's only a sales tax exemption, not a use tax exemption. And Regulation 1620B1 says very clearly, whenever a sale is exempt from sales tax, as is the case may be, whether it's under Section 6396 or under 6283, whenever the sale is exempt from sales tax, use tax applies. Now, of course, unless any of the 1620B exceptions applies. But as I've just discussed, due to the sale in California, the provision for use tax exemption under Regulation 1620B does not apply here. As to appellant's other arguments that the transaction was a sale of approval within the meaning of the UCC Section 2326, such that the sale does not occur until the purchaser accepts the property. A sale on approval is one in which the delivered goods may be returned by the customer, even though they conform to the contract. Here, however, the truth is, despite any purported understanding of any of the parties involved in the sale, and regardless of the fact that the seller bore risk of loss prior to delivery, there's just no language in the purchase agreement or the FAB of sale that even remotely suggests that appellant had any unconditional right to return the aircraft, even if the aircraft conforms to the contract's specification. The same goes for appellant's argument that the bill of sale transferred only a security interest. Not only do those arguments find no support in the purchase agreement or in any other objective evidence, they're also directly contradicted by the FAB of sale language and as well as appellant's own assertion of ownership of the aircraft in its FAA registration application and in its lease agreement. And further, those arguments defy the basic logic behind the circumstance of the strict closing deadline due to the prior owner's 1031 exchange deadline. And they defy the common sense given the parties' sophistication in business transactions. Appellant's argument that the delivery slip explicitly provided for transfer of ownership and upon delivery distorts the actual language in the slip. Instead of truthfully stating that the delivery slip's true provision is that responsibility of ownership of and risk of loss for the aircraft transfer from seller to the purchaser, the appellant represented in its opening brief over and over again that the delivery slip says to transfer ownership, which appellant then argues constitutes clear and convincing proof to rebut the FABO sale. But that proof is just made up fiction, as responsibility of ownership does not equate ownership or title. The ownership refers to the fact of having title to the property, rights to possession or control, as appellant himself acknowledged in its opening argument. While responsibility of ownership refers to being responsible for all the obligations and consequences associated with being an owner, such as taking the risk of loss, paying property tax, etc. Taking the responsibility of ownership and the UCC does not convert a transaction into a transfer of ownership. A common example we can see is in the pardon me, sorry. In the commercial lease context, it's very common to come across triple leases. So in those situations, the lessee will pay for the insurance or pay for property tax and pay for maintenance, which are typically the responsibility of the owner. But taking those responsibility of ownership doesn't make the lessee the owner without more, nor the owner a non-owner suddenly. So contrary to appellant's argument, the delivery slip does not memorialize any understanding of passing title or ownership on the delivery date. He only said responsibility of ownership and risk of loss should pass upon delivery. Similarly, appellant's reliance on the risk of loss clause as proof that the title did not transfer is misplaced. As who bears the responsibility for risk of loss is determined under California UCC section 2509, which is without regard to who has title. And subdivision B of 2509 places squarely the risk loss on seller in a contract like the one at issue, which requires delivery at the destination. As you know, when California adopted the UCC rules in 1963, the emphasis in the prior California law on title to the property in determining risk of loss, priority amongst creditors, etc., has been abandoned. In its place, the code sets forth separate rules for risk of loss, priority, etc., all independent of the location of title. This is apparent from both the comment in the official text of section 2-101 of the UCC, as well as from the explicit provisions of the California UCC section 2401. The comment in the official context of section 2-101 of the UCC states, as relevant here, that the arrangement of the present article, that's the current UCC, is in terms of contract for sale and the various steps of its performance. The legal consequences are stated as following directly from the contract and action taken under it, without resorting to the idea of when property or title passed or was to pass as being the determining factor. Similarly, California UCC section 2401 states, I quote, Each provision of this division with regards to rights, obligations, and remedies of the seller, the buyer, purchaser, or other third parties applies irrespective of title to the goods. Along the same line, courts have also emphatically rejected similar arguments asserting title based on insurance coverage. For example, in Chevron USA, Inc. versus State Board of Equalization, the California Appellate Court, in response to a similar argument, asserting title based on who carried the insurance coverage, stated, I quote, "So what?" unquote. The court went on to explain that there's no authority that a purchase of insurance by a party means that a delivery or possession of or title to the property. And that the citation to the Chevron case is 53 Cal App Force 289. So it's a settled law that a statement regarding risk of loss is not a statement regarding the passage of title nor proof of title. Appellant argues today in its opening statement that as a matter of law, there could be no sale in California because appellant took no possession or control of the aircraft. But as I stated at the outset, sale occurs upon transfer of title or possession, and as the code provision appellant himself showed upon the PowerPoint, legal possession is not, legally, no possession is necessary to establish a sale, because Variant Taxation Code Section 6006, Subdivision A, the last sentence states that transfer of possession includes only transactions found by the board to be in lieu of the transfer title, exchange, or barter. So transfer of title is the way to transfer ownership, but transfer of possession only constitutes sale when the transfer of possession was in lieu of the transfer of title. Appellant spent much time discussing the Northrop Corp versus BOE case. But that case, appellant represented that case that the title requires possession. But what the case actually said is, for example, in discussing the Turing ownership, the Turing was of course in Northrop's possession during the audit period, except for such time as rotating used Turing was in BOE's possession in Washington. This in itself does not prevent title from passing to Boeing. So while title is tied to right to possession, the evidence suggests that the appellant did have a right of possession, which is inherent in its full title to the aircraft as granted by the FAB of sale. And also the purchase agreement, while prohibiting the seller from doing anything to the aircraft after a closer escrow, other than to reposition for delivery out of state, has no limitation on appellant's right to possession or control. Of course, limiting what the seller can do after closer escrow is appellant's assertion of the right of control of aircraft. Since, as discussed previously, the evidence established that title transferred in California, the place of sale is in California, and with the sale exempt from sales tax, appellant is properly subject to use tax on its use, storage, or other consumption of the aircraft in California. And just some overall comment to appellant's opening statement. We agree with the appellant that the liability, the decision can be made as a matter of law, but not at law misrepresented by appellant. Appellant's liability is clear given the applicable law and evidence. But the law and the evidence are not in favor of him, as he alleged, but against him, as the facts are clear as established by the clear and explicit language in the aircraft purchase agreement and the FAB of sale, that the seller, the owners of the full legal and beneficial title of the aircraft, build, sell, grant, transfer, and deliver all rights, title, and interests in and to the aircraft owned Snowflake Factory LLC for. So there's no need for inference and no room for difficulty in understanding the effect of the transfer, and there's no ambiguity in the legal documents about this. And the risk loss provision, that's just provided in accordance with the UCC provision in such destination contracts without regard to title, as I just discussed. So they don't create any ambiguity about the title transfer. Given such clear and explicit language in the contracts, as a matter of law, the language of the contract, both in the aircraft purchase agreement and the FABO sale, is to govern its interpretation as clearly and specifically provided by Civil Code Section 1638. That section states, if the language is clear and explicit and does not involve an absurdity, the contract, the explicit language is to govern its interpretation. Although the parties' intent determine a contract's meaning, as case law has held over and over again, the relevant intent is objective intent, as evidenced by words of the instrument, not parties' subject matter, such as those expressed in the declarations. And to quote another case, it's Rodriguez versus Otto, at 2013 appellate clause. If the terms of the contract are unambiguous, there's no occasion for additional evidence of the parties' subjective intent, since their actual intent, for purpose of contract law, is that to which they manifested assent by executing the agreement. And of course, the Civil Code also said clearly, Section 1639, when a contract is reduced to writing, the intention of the parties is to be ascertained from the writing alone. In view of such clear and explicit law provisions, the declarations have no place at all in determining what the parties intended contract and did in fact contract. And even if the declarations can be considered, they cannot disprove the explicit terms of the title transfer provisions. As appellant acknowledges, under California law, the Evidence Code, Section 662, the owner of the legal title to property is presumed to be the owner of the full beneficial title, and this presumption may be rebutted only by clear and convincing evidence. But here, all appellant has offered as a proof is just a set of declarations which in essence are just unsubstantiated allegations, which has no basis in objective evidence whatsoever. They attract so much doubt and paint such a highly unlikely set of alternative facts, given the contract's deliberate choice of words, the parties' sophistication, and the circumstances of the strict close deadline, and the parties' course of conduct following the process rule, that in no way can the declarations meet the clear and convincing standard. Appellant may not agree with this result and attempts to muddy the waters to obscure the true facts, but the appellant's attempts to have this appeal decided on an alternative set of facts based solely on its declarations without regard to the explicit contract and bill of sale language to the contrary must fail, because, as I just said, California law requires that the clear and explicit language of the contract to govern its interpretation. And as discussed previously, the language of the contract in this case are so clear and explicit, so they will govern the contract. And the appellant cannot now make a new contract for the parties or to rewrite the clear terms of the lawful contract through the subjective intent as expressed in the declarations. And of course, even they have no proof at all, with so much contradiction with the objective evidence on the record, they cannot meet the clear and convincing evidence. And For the record, I'd like also to take a look at the party we have here. The purchaser, appellant, has as its member and manager an attorney with extensive legal and business experience in negotiating deals, drafting contracts, and structuring financing transactions. He served for about 16 years as a former partner and executive vice president, general counsel, and then vice president business affairs for Summit Entertainment LLC, the film studio that produced and distributed the worldwide box office success Twilight and its sequels. The Hollywood Reporter called him and another officer there the pair of legal eagles at Summit. During his well over decade career there, member oversaw Summit at...
I'm sorry, are you referring to information in the record, or is this outside research that you performed?
We did not put on that on the record, but this experience was covered briefly in the appellant's own declaration, which we did put in the record.
Oh, okay, thank you.
Yeah, that's in the department's exhibit E. So the member...
If I may, as flattering as the Hollywood Reporter article was, that is not in the record.
Yeah, but the point I'm making is appellant is highly sophisticated and has extensive legal and business exposure. And then seller, Fleet Planes Inc., as appellant indicated, is an established aircraft broker and dealer based in Oregon. And the party's escrow company, Insured Aircraft Title Services Inc., is a leading world escrow company specialized exclusively in aircraft transactions. So this transaction here at issue was not based on some inexperienced persons not knowing what the terms chosen for the contract mean, but instead they were done by and between highly experienced and sophisticated parties, and it involves a multi-million-dollar purchase, $1 million purchase in aircraft. So with all the parties' background in mind, let's now review appellant's supporting declarations, which indicates that the parties had an understanding that the sale was a sale on approval, or it only conveyed a security interest, or title or ownership would not and did not pass upon delivery. But by their own accounts in the declaration, based on this understanding, some last-minute changes were made to the pending written purchase agreements to reflect the parties' understanding. Given such an order of events, and given the sophistication of the parties, and the multi-million-dollar purchase at stake, as well as the handling of the escrow by a well-established escrow company specialized exclusively in aircraft purchases, and further given appellant's full understanding of the legal effect of the title document and the legal effect of a contract with obviously explicit terms, one would expect that the purchase agreement or some other written agreements, such as escrow instructions or other things, would reflect such a purported understanding if indeed the purported understanding was agreed upon and acted upon. But what is the reality? The legally binding reality is that, first off, aircraft purchase agreement and the bill of sale, the only two documents the parties executed binding each other in government transaction, give no indication whatsoever the aircraft transaction was for a mere transfer of security interest or sale on approval. Of course, the close date, mandate close date for January 27, 2015, leaves no room for contingencies or uncertainties, and has no room or tolerance for any alleged sale on approval or sale upon delivery at the destination. And then when you look at paragraph 2 of the aircraft purchase agreement, it said purchaser shall allow the remainder of the purchase price after satisfactory completion of a pre-purchase inspection. This indicates that the only occasion purchaser had to reject the aircraft is at the completion of the pre-purchase inspection, which refutes the allegation of an open sale and approval. And also, as Hazel pointed out, requiring a purchaser to pay full purchase price at the time of contract was wholly inconsistent with the idea of a sale and approval transaction. And there's no objective evidence whatsoever to support that. And then we have the FAB of sale, which stating it with such verbal plainness and distinctness that before title, both legal and beneficial title, passed from seller to appellant forever. So again, despite the highly sophisticated parties involved, appellant's understanding of the legal consequences of the documents, the parties made no attempt to place any limitation on this document in the purchase agreement or elsewhere. And even with the required delivery out of state that got into the agreement, the purchase agreement actually went into great detail to avoid saying anything to contradict the title transfer. Paragraph 5 says, risk of loss or damage to the aircraft shall pass to purchaser when the purchaser takes delivery and physical possession of the aircraft at the POX. Could have just easily said, title and risk of loss shall pass, but did not. Similarly, the delivery slip only says, contrary to what the appellant wanted to believe, responsibility of ownership and the risk of loss shall pass. It could have more easily said ownership transfer using fewer words, but again it did not. All these choice of keywords and omission of other keywords in the contract show a clear and deliberate intent to pass title in California. And the law is clear. Once you have title transfer in California, the delivery outside California does not matter anymore. And I think I'll just stop here and leave the remainder of the closing argument. Thank you.
Okay, thank you. So this time, I believe.
May I be heard?
Oh, sure, you know.
I would just like to respond if I could. And I'd like to respond with the following motion. Opposing counsel's argument is very detailed and very extensive, and I commend her on it. I would have expected to see that in the department's brief because it's very detailed, and as a matter of due process, I would have expected to see that level of argument and that level of specificity and recitation of code and regulations in the opposition brief, which was not there. I would like to move to have the opportunity to review the transcript and to respond to it in the detail that she just articulated all of the various arguments with. We were more than prepared to respond to a very detailed brief in response to our very clear and authoritative brief. Unfortunately, the department did not file such a brief. It filed the underlying decision and roughly 2 pages of argument. The argument that we have just heard goes well beyond the scope of that brief. In our preliminary hearing as to the scope of this hearing, it was to be limited effectively to the arguments raised in the brief. The arguments that are being advanced here right now are well beyond that scope, and I believe, and I'm moving the panel to allow appellant to have the opportunity to review the record and to respond to those very detailed arguments, because heretofore they have not been advanced and we have not been afforded the opportunity to respond to them.
Okay, and if I could get CGTFA's position.
Yeah, we object to that, obviously. The department's position has never changed. That sole issue is whether title transferred in California, and all the arguments, all the citations to everything else, that was raised by appellant in various points. And it also goes to the exact same issue as narrowed down in the pre-hearing conference order. So we did not bring in anything new. And in fact, appellant actually brought a lot of new facts or misrepresented facts, which necessitated us
I'm
going
going to object to that characterization as to the facts. That is not only argumentative, it is unfounded.
So there's nothing in our argument that went outside of the argument from the decision and recommendation as to the department's position as to why this is taxable. It all included where the sale occurred and how the one regulation is not applicable, as has been argued. So we have not swayed outside from the argument that we've had and have only countered some arguments that have been made today here with respect to specificity.
Okay, why don't we take a brief recess for a court reporter and then also for us to discuss this, and we'll get back about at 2:30 and resume this proceeding. That's 9 minutes from now.
No objection.
So I'll record, so we're going to go on the record. Okay, so there was follow-up. When we went off the record, we discussed the objection to new arguments that might have been raised during the hearing, and it was decided that OTA is going to provide a copy of the transcript of what is said today to the parties. At that, the parties will each have 45 days from the date the transcript is provided to provide A, their closing arguments, and B, any responses that they may have to new arguments that were raised during the course of the hearing. After the close of the 45-day period, the record will be closed, and the just written opinion will be issued within 100 days from that time frame. And the parties are not required to provide any additional follow-up during this time frame. This time frame is if the parties would like to provide closing arguments and rebuttals. Okay, so with that said, the taxpayer has indicated that he doesn't have an objection. I'm not sure if the CDTFA had an objection for the record, but if you would like to make an objection, now's your chance. Okay, so at this point, we're going to proceed with testimony from the taxpayer's representative, Andrew Majosic, after which we will adjourn the hearing. Mr. Majosic, you may proceed.
Well, I was going to set up some equipment just for the purposes of just reviewing some of the documents and issues that are relevant to my testimony.
Okay, perfect. And also, I will.
Yeah, I don't have to. There's only one or two documents that if we haven't already seen. But if it's convenient and if it's helpful, I'd be happy to do so.
Can I offer that we do have all the documents in front of us on our laptops, so if you just want to refer to exhibit number, we can look at them simultaneously.
There's only one. There's the document that's been objected to, and then of course I make reference to the current FAA registration form as a basically ask for judicial notice of it because it is distinctly different from that which was signed in 2015 and is relevant effectively to the issue of credibility and certification.
Is the current FAA document in the record?
It is not. It is, but it is on the FAA website and it may be judicially noticed.
Okay.
And it only goes to the point as to the certification. I can make that point in my testimony in relation to the certification required and the associated penalties for misstatements.
Okay, why don't you just do the testimony at this point? I don't think we need, since it's something that we potentially could take official notice of. But at this point, I'll have you swear. You could raise your hand and stand and raise your hand. Do you swear or affirm to tell the truth, the whole truth, and nothing but the truth?
I so swear.
Okay, thank you. You may sit.
My testimony is a prepared statement, after which I'm certainly open to obviously questions. Members of the panel, counsel for the department, I'm Andrew Mattisich, the founder, manager, and a member of Snowflake Factory LLC. I appreciate the opportunity to be heard on this matter. In addition to my testimony today, this panel has before it the previous submitted sworn testimony of 4 other recipient witnesses to various aspects of the transaction under consideration today. Mike Stevens, the president of the seller, Fleet Cleans Inc. John Barnett, the seller's forwarding agent and a recipient witness to the formation of the agreement between Fleet and Snowflake. Mike Talbot, general manager of Glacier Jet Center, with whom I personally negotiated a hangar lease agreement for the storage of the aircraft after Snowflake accepted the aircraft in department. Tom Johnson, founder of Air Power Insurance, who brokered the first insurance written on the aircraft.
I'm sorry, I'm being asked if you could slow down a little.
Oh, I'm sorry.
Recording this.
Okay, I'm sorry. Tom Johnson, founder of Air Power Insurance, who brokered the first insurance written on the aircraft for Snowflake, which was issued on February 10, 2015. None of these declarants owed me or Snowflake any obligation, or owe me or Snowflake any obligation. None of these individuals has been shown to have any reason or incentive to state anything but the truth in their sworn declarations, and I know personally of none that would so incentivize them. According to the declaration submitted, each was under oath and aware of the penalty of perjury, as was I in submitting my declarations. The department, however, has attempted to impeach my sworn testimony, and by implication, that of the other declarants in this matter, not by cross-examination or by calling recipient witnesses, but with the following 4 documents: the form bill of sale, the signed registration application, the signed hangar lease agreement, and the declaration from me that accompanied the initial filing with the department in August of 2015. This prepared testimony attempts to contextualize the documents and their intended purpose and to counter the department's many assertions about them, and by implication, about my veracity and my credibility. It is my veracity and credibility, according to the department, that is at the heart of the department's case. It is fair for you to question me. It is fair for you to wonder whether there is an ulterior motive. Obviously, the tax liability here is not insubstantial. Certainly, one can ascribe to me a motivation to be less than truthful in the declarations that I have submitted to the department and to the testimony that I'm giving you today. It is not, however, by implication, fair for the department to ascribe that to others. So who am I? If you're going to judge my veracity and my credibility, if that is central to the department's case against our position, who am I? I'm a Montana native, where I flew from yesterday to be here today. I received my undergraduate degree in political science and history with a minor in Russian language from the University of Montana. For just short of 5 years, I was an analyst with the Office of Soviet Analysis at the Central Intelligence Agency in their headquarters building in Langford. In 1989, I left the CIA to attend the University of Virginia School of Law. Please do not hold any of the typographical errors in my brief against that fine institution. After law school, I practiced with 2 national law firms. And in 1995, I left private practice to become the general counsel of a small entertainment company that opposing counsel referenced. Summit enjoyed some commercial success. In 2012, we sold the company, and I founded Snowflake. In addition to some entertainment properties that the company continues to develop, Snowflake invests in startup companies, real estate, and other businesses. I am a private pilot, and although I have been a partner in aircraft in the past, I personally had not been involved in the acquisition of an aircraft prior to the acquisition of the aircraft that was the subject of these proceedings. My prior ownership was simply to buy into a partnership that had already acquired the aircraft prior to my buying. Although Snowflake had been looking for an aircraft for almost 2 years by the time the opportunity to purchase 441 X-Ray, the aircraft in issue here, I was still relatively unfamiliar with the process, documents, and significance of all, for tax purposes, the various forms to be filed at the time of the transaction. Yes, I am an attorney admitted to practice before all the courts in the state of California. Yes, I am also a businessman. But in this transaction, I was acting as neither a sophisticate nor was I acting as an attorney. This transaction was supposed to be a simple one. As I stated at the beginning of my argument, it was supposed to be an organ plane owned by an organ company, brokered by an organ broker-dealer that was supposed to be consummated on the ground in Portland, Oregon. Prior to January 23, 2015, the basic one-page agreement with the original seller, MV Forger, that Mike Stevens prepared and had concluded with all but signature when Snowflake received the news that there was a 1031 exchange that had to be handled on a hurried-up basis.
I'm sorry, just a reminder to talk a little bit slower.
I apologize.
Reading always makes you talk backwards. Talk about
Yeah, I'm sorry, I feel awkward. I apologize again. So, on the 23rd of January, when we found out that MV Forger wanted to close at 1031, I objected. The plane was still going to be in California on January 27th. We did not bargain for a California plane. And we were not entirely aware of all of the issues at that time that would flow from acquiring a California plane. As I said at the beginning of my argument earlier today, no good deed goes unpunished. We would not be sitting here if I had just said no to the deal. But I was persuaded to see if we could not make the deal happen in the time that we had available to us. Barnett suggested loaning Fleet the money to buy the planes so Fleet could conclude the sale in Oregon, and I welcomed that degree of creativity. My concern was timing and how to properly secure the money that would be used for the loan. Stevens objected to a full set of loan documents, and it became obvious there really was no time for that. The escrow agent then said that she could easily process two sets of paperwork as much as she could with one. One set for the transfer from MVF to Fleet, and a second affecting the loan from Snowflake to Fleet. According to Barnett, it was she who suggested using the bill of sale as collateral, a security instrument, something that she said had been done before. So we agreed the FAA bill of sale would be security for the loan. The loan would be used by Fleet to buy the plane. Fleet would conclude the work that was remaining to be done, make it airworthy, turn it over to Barnett, and have it delivered to Oregon, where the deal would be consummated and concluded as originally contemplated with MVF. Now, during this process and in other prior plane deals that Snowflake had come close to concluding, the FAA bill of sale had almost always been referred to as the title. I knew that there is no federal title, per se, for aircraft. I knew that the FAA bill of sale would be used on the FAA registry to give notice to potential creditors and other purchasers. But we, Stevens, Barnett, the escrow officer, referred to it as a title, like a paper title to a car. It does not mean that I was, or any of us, were forming any legal opinion about what constituted title in the state of California, or that we understood, despite any ascribed legal sophistication, that we understood the arcane nature of how title is used under the tax code of the state of California. We use the word title as a colloquialism, shorthand for the document, the FAA bill of sale. Now, there's not more than I can say about the form that has already been said. I just want to reiterate that it was not my intent that that document was to convey title. The agreement between the parties, from my understanding of the agreement, was that it was not conveying title. Now, the registration. The department has introduced the FAA aircraft registration form that I signed on January 27, 2015. They point to its date that it certifies ownership, that it has my signature, and they basically ask the question, if you told the FAA on January 27, 2015 that you own a plane, then why are you telling the state of California now that you did not? That's a fair question. And if I were sitting in your seats, I'd be asking that question. First, this is the first time that the department has produced the registration form as evidence or rebuttal during the administrative review process. If my memory serves correctly, it was mentioned in passing the department's analysis after our request for a redetermination, but it was not produced. It was not mentioned in the decision, nor was it mentioned in the department's brief in response to our opening brief here. It only came in on the sua sponte request from Judge Quee to have additional documents added after we had concluded our briefing, and the department had decided not to file a reply to our reply. Now, that doesn't mean that the document isn't valid. That doesn't mean that the document doesn't stand for its proposition. And that's fair. I'm saying this because my credibility is an issue here. There seems to be an implication that by not raising the registration in any of our paperwork, that somehow I was trying to hide something from this panel, which is not the truth. Had it been raised in their response to our brief, we would have addressed it and addressed it squarely, as I'm about to do factually with my testimony. When I signed that document in 2015, there was nothing nefarious going on. As I just testified, this was Snowflake's first rodeo, so to speak. This is the first time that Snowflake, and certainly I, on behalf of Snowflake, have been involved in an aircraft purchase transaction. both the bill of the sale and registration were processed through escrow. Yes, it was a sophisticated escrow agency, upon which I was relying. As in the purchase of a house, all the paperwork other than the written agreement originated and was processed through escrow. Regarding the registration application, Snowflake had been advised by the escrow agent that in order to lawfully fly the aircraft, it would need a pink slip. And back in 2015, there's an actual physical form, the final carbon copy at the back of the registration was pink. At the bottom of the registration form, unfortunately, it does say that holding that pink copy allows the registrant applicant to fly the aircraft under the authority of the application for up to 90 days. The escrow agent had advised me that in order to fly the aircraft after we accepted the aircraft, we would need that pink slip. So as a matter of course, I signed that document as of the 27th so that it could actually be submitted to the FAA. The pink slip could actually be in our possession, and as and when the aircraft is accepted, we would be able to lawfully fly. Now, I take the department's position, and I take it very seriously. I'm a member of the bar of the state of California. I'm a licensed pilot to fly federally. I do not take lightly making misstatements to the Federal Aviation Administration. I do not take lightly and have not made misstatements of fact to the state of California. The registration as filed on January 27, 2015 was, yes, technically an error. We did not own the aircraft on that day. And although the document is being disallowed in admission into evidence, after consulting with an attorney in Oklahoma City and positing to that attorney the circumstances of how that document was signed perfunctorily in order to get a pink slip, and advising the same as to the actual facts of this transaction, we have self-reported to the FAA that misstatement on that form. And this is where I would bring up today's form, because it is materially different from the one in 2015. It says squarely and clearly on its face that a misstatement is subject to criminal liability, up to a $250,000 fine and up to 5 years in jail. So if you want to doubt my veracity, consider that I am, within the statute of limitations, submitting and self-reporting the error on that form to the FAA, and am prepared for whatever consequences flow my way. Because I am not misstating the truth to you, members of this panel in the state of California. The department also relies on the contract with the Glacier Jet Center. The declarations already in front of the party, in front of the panel, clearly indicate that that agreement was not concluded until February 11th, 2015. The declaration or statement under oath of Mike Talbot, who was then and still is the manager of the Glacier Jet Center, affirms that that agreement was not concluded until the 11th. It was signed on the 11th and was backdated only for the purpose of their internal administrative convenience. The lease payment was a complete annual lease payment. It was a number that we bargained over and concluded while I was there on the 11th. So the contract did not actually form. The recitals in the contract as to the ownership were just between the parties and part of their form. It was not a statement that we owned the aircraft on the 1st. We weren't even there on the 1st. The agreement was negotiated and agreed on the 11th. Finally, my declaration from August 20th, 2015, I believe. In filing the paperwork asking for the exemption, the interstate commerce exemption, I did state that we took title to the aircraft while the aircraft was here on the ground in the state of California. That was in reference to the FAA bill of sale. I stated as much in a subsequent declaration on August 20th, 2016, Now, the department didn't produce that declaration. They didn't produce the declarations that were submitted in support of that declaration. It's a one-way ratchet with the department. They don't ask for clarification, or have not asked me for clarification. But we did clarify the nature of the FAA bill of sale. Finally, there is the conduct of the parties. I ask, not entirely as a rhetorical question, why, if we intended, as I did not, title to transfer to the state of California, why didn't I just jump in the airplane and fly to Portland? Why did it have to even go to Portland? Why did it fly to Montana? Why was it flown in interstate commerce? Why did we bother to go through the application? Why, if in fact we felt that title transferred in the state of California, would we even bother? I can assure you that in the 5 years since we made the application, I have spent personally more hours on this matter than the tax lab, if you were to attach a standard billing rate to me as an attorney or even a salary to me as an entertainment executive, then this matter is worth. That doesn't say anything in and of itself, but it would hopefully go to my veracity and credibility as to why we are continuing to pursue this. The economically efficient matter would be to simply admit, pay the tax, and be done, but that is not the truth. There's really nothing more I can say, but if you have any questions, or if the state would like to cross-examine me as to my veracity, I'm certainly open.
Right now, I believe at this time, City TFA does have an opportunity to ask questions of the witness.
We have no questions.
Okay. So I do have a couple questions that my panel members may also, but I just wanted to clarify, and I think you might have discussed this at the beginning of your presentation. So with regards to the $1 million payment that was made to the seller for the airplane, was that paid through escrow?
Which payment?
So the aircraft purchase agreement, I understand that there was a sale for the airplane for $1 million, and that's referenced, I believe, in your purchaser's declaration exhibit B. So appendix B, exhibit B, where it says Fleet Planes Inc. an Oregon corporation hereby agrees to sell to Snowflake Factory, a California limited liability company, a 1982 Cessna Compass serial, for the sum of $1 million under the following conditions. And this is the document that was discussed by both parties. I just want to make sure I understand details here. So that $1 million, that was paid through escrow, is that correct?
$1 million, yes. $1 million, I think actually at the time, escrow may have already been funded. I do not actually recall as I sit here today, but escrow may have already been funded in anticipation of the MVF Snowflake transaction. And so the $1 million was sitting there. That was part of the convenience. The money was there. The money was readily available. Fleet Planes didn't have it and couldn't basically sort of affect the two-step transaction that Barnett suggested. So,
okay, so I guess what I was trying to clarify is because escrow closed on the 27th, is it correct to say that the $1 million was paid was dispersed from escrow to the seller on the 27th, January 27th?
Well, whether the money went from the escrow account to the seller or it went directly to MVF, honestly I don't recall. I'm happy to supplement that with an actual factual statement to that effect. But I honestly don't recall. But its purpose was to be used by Fleet Planes to pay MVF. MVF did transfer ownership of the aircraft to Fleet, and Fleet, by virtue of the bill of sale, represented that it had title. And there is, as a matter of record, which you can take judicial notice, there is an FAA bill of sale, I believe, from MVF to Fleet on record.
Okay, so basically the disbursement of funds wasn't held up on the acceptance of the delivery in Oregon at 210. Is that
Well, the funds had to be paid to MVF for Fleet to acquire the aircraft.
Okay.
Yeah, so that had to happen. That was the hurry-up nature of the 1031 exchange.
Okay. And
They needed to close that. They needed to close that deal, and that's why John Barnett suggested that Fleet could interpose itself between MVF and Snowflake, and then complete the sale in Oregon.
so, I guess one difficulty I'm having grasping this is it seems you have the 1031 transaction with the original owner of the aircraft, and in order to qualify, I guess they have to make an exchange or sale within a certain amount of days. And I'm just wondering, is it the case that they're saying, hey, the sale occurred on January 27th because that's our deadline for the 1031, but then the Snowflake factory is saying the sale occurred on 2/10 because that's when the out-of-state transaction occurred. So I'm just wondering if there's like some conflict there that the parties actually both wanted different days, and this agreement was trying to consolidate it so that there was a sale for the Snowflake on the 2/10 and a sale for the ultimate owner of the seller of the aircraft on January 27th. Is that?
Yeah, look, I understand. It's a form over substance question, or substance over form question, I suppose. This is not an artifice, right? It was not our intent to construct an artifice. Our intent basically was to do a two-step sale. Sale one, MVF to Fleet for $1 million. So Fleet sold, or excuse me, MVF sold Fleet the aircraft for $1 million. Fleet has attested to that. Title while the aircraft was sitting in California. The transaction between Snowflake and Fleet was not a sale. It was a loan that was basically repaid when the aircraft was ultimately accepted in Oregon. So the 1031 exchange was complete as of the 27th. As far as I know, I'm testifying to things outside my direct knowledge. I assume that they concluded their 1031 exchange because they had asked, MVF had asked to conclude that part of the transaction. So they got the airplane off their books. It was sold to Fleet. And that basically ended MVF's involvement in the transaction.
Okay, and I guess on the aircraft bill of sale that has been discussed with other parties, I guess I'm just trying to understand, because that does have the language that the seller does hereby grant, sell, transfer, and deliver all the rights, title, interests to such aircraft to Snowflake, as Fleet claims to Snowflake. And I'm just wondering the legal significance of this document, because it appears that it was recorded with the FAA, and trying to consolidate that with the argument that, well, the other document, the aircraft sale purchase agreement, required acceptance in Oregon, and I'm just trying to figure out the rights of the parties if, for example, there was a dispute with the acceptance because, the sale, this FAA document says that the sale of rights, title, and interest occurred on the 27th. I'm just trying to, consolidate or put the two together and how they interact together. That's kind of a difficulty that I'm trying to understand.
Sure, I understand. And I appreciate the state's attribution to me to great legal sophistication, but in this transaction I was acting as a businessman. It was $1 million transaction, and I know that seems like a lot of money, but in the world of airplanes, $1 million is not a lot of money. You can get a modern small aircraft that are doing today, four-seaters, approach $1 million in cost. It's just the nature of the cost of that transaction. And this was a plane that was readily available. We've been looking for a long time, and the deal was a hurry-up deal. At some point, as a businessman, what you do is you say, let's not get in the way of the transaction. That doesn't mean that we were sloppy, but the contract that you're having difficulty with, if I understand your question correctly, was the original contract between MVF and Snowflake. That's how it started. And that was very clean and very easy. The date of the anticipated closing was not the 27th. It hadn't even been formally decided and agreed because we didn't know whether the aircraft would actually be finished and done. The seller couldn't actually tell us when that plan would be finished from its post pre-purchase inspection correction work. So that document was, over that weekend, hurriedly modified within the artificial constraints that Stevens imposed of he wanted to keep the document to one page. I have said in my declaration, actually, that I rue the day that I didn't actually insist, as a matter of fact, that contract had more detail. But I was relying on the fact that I had John Barnett, who understood what the true nature of the transaction was. I wasn't expecting Fleet to contest it, and by virtue of their declarations, they have not contested the nature of that transaction. It was, let's get this done, and that document was not well-purposed or well-suited for the two-step transaction, admittedly. But the fundamental elements of the transaction, as I argued earlier today in argument, are there as to the delivery certificate and the intent of the parties as it related to the agreement. So the intent was clear, and this is again, it's a two-step transaction. So the document you're looking at really has no bearing as to the Fleet MVF transaction. You would have to ask Fleet and MVF what transpired in their transaction, and you'd have to ask MVF whether or not they met the requirements for their 1031 exchange. This document, unfortunately, was basically a sales contract that had to be modified at the end in a hurry-up fashion to accommodate that 1031 exchange, but it doesn't relate to their 1031 exchange at all. So it's not as though you're telling the IRS, Snowflake had nothing to do with 1031. Snowflake is not telling the IRS, oh, here's a 1031, and then telling you, no, there was no 1031, because that happened 10 days later. That was the point of doing the two-step deal, was to allow allow MVF, by selling the airplane to Fleet, to meet its time deadline, and to create more time to get the aircraft finished and ultimately back to Oregon, where the deal with MVF was supposed to happen. So MVF's out of the picture. Fleet has assumed ownership and responsibility for the plane. Basically, Mike Stevens, as the broker for MVF, said, I'm going to step in and effectively do you a favor. I'll take ownership of the airplane. You guys get your 1031 done, and I'll deal with Snowflake. Does that answer the question? I'm sorry.
Yes, I believe that was helpful. I'm not sure if my co-panelists have additional questions. I'll turn it over to Kristen.
I'm also trying to wrap my head around the fact that both sides have referred to escrow and what's in there and what's not in there, but we don't have that in our record. Is there any existing copy of the escrow instructions?
I don't know. Honestly, I don't know whether we have the escrow instructions or not. I can certainly look.
I'm not sure if that's, it might be a little bit too late for that, but so I guess we're going based on whatever your recollection of what was in escrow is at this point.
Yeah, unfortunately, at this point, unless, again, if you want to open up for additional document submissions, sort of if I can find them.
Yeah, I'll leave that up to Mr. Quee, whether he wants to do that, Judge Quee, but I do want to know just a couple of things that I think would be helpful. Was you believe that the whole transaction was involved in one escrow, so MVF sold and was out, then Fleet became the owner?
Yes.
And was there ever any follow-up with the release of the bill of sale lien or cancellation of the debt, because Fleet, until you received the plane, Fleet owed you $1 million, and you had a security interest in their jet?
It's actually not a jet; it's a turboprop. But we were holding that. We were holding the bill of sale as security. We did not. I think that was the point of opposing counsel's argument. She questioned why didn't we even bother to file. I think it was a one-page form. And again, despite my reported sophistication, I was unaware that there was a one-page security form. It was not proposed by the escrow agent at the time. And so we did not file the form alluded to earlier in argument by by opposing counsel. And so we were holding an FAA bill of sale, which I don't want to engage in argument, but is not titled itself. It is a document filed on the FAA registry that puts people on notice, and the FAA acknowledges this. It is decided under state law. But there was no sort of formal cancellation that had to be filed with the FAA, because the whole point was to put potential creditors on notice with the actual bill of sale. And that's what the bill of sale and the registry is for, as I understand it. And I could be wrong, I'm sorry. Again, it's not necessarily recipient testimony, but as we understood it at the time, the registration with the FAA was simply to put other people on notice. And so we affected our purpose of securing our interest in the loan in the aircraft, because in theory it wouldn't be able to go anywhere without somebody doing a title check and saying, oh, there is this bill of sale here, what does this mean? But the ultimate meaning and the ultimate intent, as I understand it under law, is the intent of the parties. Whether the FAA bill of sale we actually have this in our brief, whether the bill of sale affects transfer of title or not is up to the parties. It is the intent of the parties, and I understand from the perspective of the department trying to understand what the parties actually did or ascribing motivations to our conduct that may not necessarily be there, but the FAA bill of sale was not intended to convey title. Effectively it merged on acceptance of the aircraft. And that was kind of the beauty and the simplicity of the transaction. I'm sorry.
Yeah, you're going back to argument, so
I apologize.
Just stop you there, but then I do have another question though, because you posited here that MVF as of the 27th was out, which in
That
your
is my
testimony,
understanding. Yeah, that is my understanding, yes.
in your testimony, that would make Fleet then the owner
Yes.
until that delivery and acceptance.
Correct.
Therefore, when you signed the delivery and acceptance agreement, and it lists that the risk of ownership is on the seller, does MVF, is MVF referred to as the seller at that point, or Fleet?
No, the documents on their face should be clear. Fleet is identified as the seller in the one-page main body of the agreement. Fleet is identified as the seller on the delivery certificate. And so in reference to the seller, Fleet was the seller. So in the two-step transaction, in the second part of the transaction, Fleet took ownership and sold the airplane.
And who hired Mr. Burnett?
Mr. Burnett was hired by Mike Stevens, Fleet Transit.
So he was in the employ of Fleet at all times.
Yeah, I mean, based on his testimony, as I understand it, what Mr. Barnett did or does was to act in his capacity on other transactions. So he was engaged, and I'm not privy to the terms of their relationship, but he was engaged by Fleet and was acting as, he was appointed as an agent of Fleet. That's the appointment of agency form, which was specifically called out in the agreement. And then on the 26th, that document, which was exchanged between the parties, he appointed Mr. Barnett as the agent, as the seller's agent.
Okay, so I believe at this point we're ready to adjourn the hearing, unless there's anything further the parties would like to bring up before we close this hearing today. Okay, so then today's hearing, well, thank you everyone for coming in, and the judges will be holding this record open. Basically, it'll probably be 2 weeks before we provide the transcript to you, possibly 3 weeks. At that point, the parties will have 45 days to provide their closing statements and any follow-up rebuttals that they have. OTA will let the parties know when the transcript is available. Is it possible that we can contact the parties by email to let them know and to furnish the transcript by email. Is there any objection before?
No objection, Your Honor.
Proceed to that?
No,
Okay, so we will contact you as soon as the record is available. Basically, today's hearing is now adjourned. The record is being held up. Thank you.
Thank you.